was not. I think so. I worked outside all day Saturday. Then we had supper with Saturday night.
Good morning. How
Morning.
are you? How are you?
Hey.
Good to see you.
How are you this morning?
Good, thank you.
Good,
You been
good.
doing okay?
I've been hanging in there.
Good.
Pretty good.
Good to see you again.
Nice to see you as well. How are you this morning?
Good. You're
Good.
stuck with us today?
I'm with you today. All day.
Today.
You got me.
Good.
So,
Well, we
yeah.
appreciate it.
Yeah, they're clipping the wings off. They're saying, hey,
Yes,
Yeah, please.
you know. So, yeah. But I assume the TV made it back.
it did. And so we're going to have a commissioner who's going to be joining virtually today. So we're going to be
Okay. Any videos?
No, it's just a slideshow.
Okay.
Yeah.
Okay. How many presenters?
So, let's see. One,
So we don't touch the string. Wait, I responded to Justin. It's everywhere.
When I started doing stuff,
Well, in this building, it is. This guy is.
Where does she, is she still at,
Well, it is 9:02, I think. Thank everyone for being here this morning. I'm sure everyone read over all 92 slides for prepared for the day. But I do want to thank you for providing them in advance. It's an opportunity to get your head wrapped around before we begin. Commissioner Wisenhunt, actually, she told me that she would have to leave her screen off because she was going to have to get up and move around a lot. So anyway, Gloria certainly good to at least to see your little icon up on the screen. So welcome. And, good. Without any further ado, happy to turn the meeting over to Chantel Robinson. That's going to do an agenda review. Thank you.
Thank you, Mr. Chairman, and good morning, Commissioner, staff, and guests. We have a full and important agenda today. We hope to wrap up by 12:30. As I prepare for my first manager's recommended budget next month, my goal today is to ensure the board continues to have a clear understanding of the key components of the budget, the challenges we're navigating, the opportunities ahead, and the strategic solutions we're proposing. And so we're going to begin with an HR update this morning because our people are our greatest asset and represent a significant portion of our overall budget. From there, we'll provide an update on the FY25 budget outlook, revisit our fund balance discussions, and hear from our financial advisors who will explain the impact of fund balance decisions on our bond ratings and share some preliminary projections. We'll also cover capital projects as we begin the critical work of addressing long deferred maintenance needs. And finally, we'll wrap up with a preview of key drivers for the FY26 budget. I do want to emphasize that while we can't fix everything in a single year, we are laying the foundation for long-term financial sustainability. And our primary goal is to structurally balance the budget, ensuring that we're not relying on one-time revenues to fund ongoing recurring expenses. And so as a team, we're approaching this with discipline and transparency, and I'm confident that together we're moving in the right direction. I do want to take a moment to recognize and thank our incredible staff, department and office leaders for the hard work that's been happening behind the scenes to get us to this point. Certainly we'll take breaks as needed. And with that, I'll ask our HR Director, Shannon Hutchins, to kick us off.
Good morning.
Morning.
The next several slides here are just going to give you some historical staffing data. It shows you where we've been, where we are now. This graph here goes all the way back to 2012. You can see that we had a few years that we were very abnormal as far as hiring. Lots of hires in those years. This year to date, we've had 327 new hires. Which tells me that we're finally starting to level off a little bit. This is the same information that you just received, but it's broken down by department. The county's 4 largest departments in comparison to all counties going back to 2018. County employee separations. Same years that we were doing a whole lot of hiring, we were also losing a lot of employees. The last few years have been abnormally high. This year to date, we've had 293 separations, which again appears to be leveling off.
I just want to, can I ask a quick
Yes,
question?
sir.
If you take that 293 for year to date, I assume in 25, we're on a quarter of the year. I don't know what the cycle is of resignations, sort of pretty even throughout the year, but that number could get multiplied by 4, I take it, right? Am I reading this?
No,
We got it right
we
today?
would probably add about 33 per month for the next 3 months.
It's fiscal year, not calendar year.
Yes, fiscal year.
Thank you.
Sorry.
Thank you. Year to date is little.
Fiscal year today, sorry.
All right, I do see FY for 25, I got it.
Okay.
Thank you.
Just like the hires by department, this is the separations by department, by the county's largest departments, which is, sheriff, social services, public health, emergency services, and then all other.
It would probably be helpful to see those in percentages because of the size of the departments. I mean, the sheriff's
Yeah.
department's so
Okay.
much larger than EMS, for example, and you get an idea of where your kind of bigger percentage separations are instead of with an actual raw number.
Okay, I can send that, yeah. Staying on separations for a minute, this is employee separation data from fiscal year 2024, fiscal year 2025, and then the reasons for the separations there. You'll see the largest numbers, of course, are involuntary. We had some involuntary dismissals, Our two largest are from retirement and voluntary, resignations. We have had 5 deaths this fiscal year. And I just threw this in here because I thought it was neat, but this is the hiring and separation trend for fiscal year 2025. You can see that, again, leveling off. There for a while, we were losing more employees than what we were hiring. Still have some of that in the trend, but you can see there's been some times where we've met right at it or above. And this is through March. The county's vacancy rate, we're at 13%. I'm not getting too excited about that, but I am excited about that. That's a big change from where we were the last couple few years. And turnover, again, you can see, especially during the pandemic and thereafter the pandemic, we were really high with county turnover, county employee turnover. We are currently at 12.6% in county turnover, which is, of course, that's fiscal year to date. That's really good. I'm excited about that. Employee recruitment and retention. So county vacancies and turnover have begun to recover from the pandemic. As a whole, the county is in a much better staffing position than what it has been over the past few years. There are still staffing challenges. Although improved, we still have some challenges with paramedics, nurses, telecommunicators, detention officers, skilled maintenance, and child welfare social workers. I will say that there are some other areas that just ebb and flow. Labor market comparisons. The North Carolina unemployment rate since August of 2024 has remained at 3.7%. In July of 24, North Carolina unemployment reached its highest since January of 23 at 4.3%. But as of January 2025, Forsyth County's total labor force was right at 186,000 with 7,300 unemployed. The unemployment rate in Forsyth is 3.9%. So some employee impacts for the upcoming budget year. Each year the county conducts a comp and class study that's performed by PTRC. The compensation ranges and job descriptions of peer counties and municipalities are used as comparisons. The study is conducted each year to ensure that the county remains competitive in the market. We just have received some data, but staff are reviewing the data, preliminary estimates to implement the class comp adjustments for the upcoming budget year is right around $2 million. Some additional employee impacts. The local governmental employees retirement system employer contribution is projecting an increase effective July 1st, 2025. But that has not been determined yet. It should be determined at the end of this month. The projections are 15.94% law enforcement employer contribution. That's up from 15.04% in the current fiscal year, and a 14.35% non-law enforcement, and that is up from 13.6%. Pay for performance, the county manager, I believe, intends to recommend up to a 6% recommendation, and that is in line with what we've done this past year.
For FY 25, roughly, what are we running on the average of that pay for performance?
Let me get that information to you.
And I'm also curious about kind of what the budget impact is for the 1 to 6. And kind of curious what it would be for 1 to 5.
I'll get that information to you. So talking about health insurance, we have approximately 4,000 members on the health insurance. That's, about 1,870 employees, 287 retirees, and 2,100 dependents. The county's health plan continues to have reasonable rates and deductibles. Lower vacancies and increased claims costs have put pressure on the plan. Human Resources and the Contracted Benefits Consultant are reviewing options with county management. Now, premium increases in the past several years have averaged about 3% shared cost. Projected estimates show a need for a funding increase of approximately 20%. And with that, I'm gonna hand it over to Terry, to let her talk about the internal
Yeah, we're
services.
gonna look a little bit closer at what's driving that 20% increase, in funding need for the internal service fund. I'll step back a minute and review. The internal service fund is where we account for our health and dental plan. Employees put contributions in, the county puts contributions in, and then we pay claims out of that. The intention is, any years where we have put more money in than claims that had to be paid, we build up a little bit of a reserve to guard against years where claims may exceed expectations, or just the volatility that might exist in some of those numbers. We don't take that money and just buy commercial insurance. We actually are self-insuring up to a stop loss level. So we do buy some commercial coverage for extraordinary claims. But for the most part, we're funding out of pocket any of the claims that we experience. We get our estimates of how much money needs to go in this fund and what we expect to be paid out of the fund from our benefits consultant. And in looking closely at what's happened in the last couple of years, the information that we've gotten from the consultant has not been realized, or the expectations, the estimates have not been realized. This particular slide looks at the revenue that went into the internal service fund. The bars in blue are what we had budgeted, and green is what we actually had collected. So this would be revenue coming into the plan, and you see in most years, we did not collect as much as the consultant had estimated we should. In particular, the last 3 or 4 years. It's been a noticeable decline. We were able to absorb some of that. Next slide. Because on the claim side, again, budget in blue, actual experience in red, we had been paying less claims than what we had budgeted, so that a little bit less revenue realized really wasn't causing a problem. But you see in the last 2 years, or in fiscal 24 and on pace for 25, our claims have exceeded what we had budgeted. So they've exceeded what we had estimated and put in there in terms of revenue. This has resulted in a sharp decline in the reserves that are left in the internal service fund. If you look back here at fiscal 23, we ended the year with $6.6 million left over to cover future years. In that particular year, we had added almost $1.5 million. Going into fiscal 24, you see here our claims experience $34 million, where the budget given to us was $31.2. Revenues, again, did not come close to meeting budget. We drove the internal service down by $3.7 million, ending the year with just $2.9 million. Fiscal 25, we're seeing much the same continuation of this trend, where claims are exceeding what we had budgeted and revenues are underestimated. We've taken a deep dive into the numbers that the consultant has been giving us, and really I think there were some fundamental errors in there. Enrollment coverages were not accurate, and the averages he was using on some of the claims experience didn't seem to take into account the fact that we were understaffed for a number of years. And as Shannon just explained, as our employment rose, those weren't really good indicators of what our claims experience was going to be. The long and the short of where we are this year, if we estimate out, continue the patterns that we've seen so far through, I think this was done as of February, we're seeing a drop in the internal service fund of $5.4 million, which will put it in a negative $2.5 million position. So we're looking at some ways to remedy that, and I think Kyle's gonna touch on some of that when he goes through our fiscal year-end update. But because we now have better enrollment numbers, coverage level numbers, we feel like we have a better estimate on what our claims experience really will be going into fiscal 26. And that's requiring us to really increase the level of funding that needs to be provided.
So who's doing that work, us or our provider?
The provider is providing us information, and we are scrutinizing it much more closely than we have in the past.
Yeah, and you look at that chart, kind of, it was running along go back one more. things are those early years, 'cause that chart's in, starting back there at 16 on the far right, running pretty good along till you get to about 2021. And admittedly, the pandemic created some issues probably, but it doesn't explain kind of what's been going on. It's like, it becomes who's been sort of minding this. And I guess that might be a dual responsibility, the provider and us too, both. I mean, kind of looking at that. And I guess the recommendations that are being made for the provider, have we always matched those?
No, so what I will say, it's a combination of things. So as Terry stated, I mean, the enrollment numbers, as we've been doing a deep dive, have really been inaccurate. But there have also been most years where the consultant has recommended a higher budget amount that we have not taken that recommendation. And so we've been eating into the internal service fund, which is really fund balance, which, as you know, Terry showed, we've been able to absorb that, but the more and more we've continued to do that, the more it's been spent down. And so as we've been really working hard this year to evaluate all of our finance and budget issues or matters, I'll say matters, we really have been also doing a deep dive on the internal service fund. But this is clearly not a new issue, it's just we're paying closer attention to these things. And then, you know, of course, we have John Sharp here, who's also been helping us on the budget and finance stuff. That's really helped us to enlighten us on some of the things that we have not historically closely tracked.
I was reading over the materials for the presentation last night, and just two quick questions. I assume that these numbers are taken into account in your fund balance calculations that you'll be going over later.
Yeah, so when Kyle talks about the year-end estimates, we're gonna try to connect the dots on some of the solutions we have to try to get this back in order.
And forgive me, but I do not recall being briefed on an issue with the internal service fund in the last couple of years. Am I just not remembering it, or did?
I don't think we've ever talked to you all in depth about internal service fund. And this is a huge portion of our budget, which is why really, you know, for me as a new manager coming in, and really not just new, just something I think we should be doing, I think it's important for you to understand all of the key components of our budget, and this is a big one.
Thank you.
Yeah, if my memory's right, Mr. Bessie, we had to shore it up once in the past, and it was probably, I mean, time does fly, but it was probably 5 years ago or so. And at that point, 5 years ago, we got into it a little bit, not quite at this level, but we got into the issue that the focus was more on the actual cost had been fluctuating a lot, and we had a lot of discussion about spouse rules, the rules of spouses of employees, and who's covered or not covered, and do they have coverage or not. We got into a lot of that discussion at that point, more at kind of a policy issue, and caused more by aberrations and more use, less on structure or in terms of how the internal services fund, you know, would work. It was dry. We needed to put some, and my memory is it was in the 1.5 to 2 million kind of range, kind of number back about 5 years ago. That's my memory. But obviously, I'm assuming our provider provides us, you know, because we have this sort of, there's the benefits we offer, and then the structure of payment, about how much is employee, how much is employer, all that kind of business. Do we know what does the provider provide us what other urban counties are doing, for example, or particularly what are our competitors? I mean, the counties that touch us essentially in this area, kind of how are we? I mean, are we providing? I remember the times I've gotten into it way in the past. The actual coverages were pretty much. Everybody had to pay something, which is a factor. My comparison was state health plan. I mean, state health plan covers all state employees, covers all teachers, it covers, you know, it covers, and actually covers a few counties. I mean, mean, if smaller counties are you're able to apply, we are too big, we would not be accepted into the state health plan. But that part is the coverages I thought were in excess of what state employees. But every employee had to pay something, which some state employees don't have to pay anything. But the difference is there are some pretty stark differences. And I'm kind of curious, when everybody's kind of on their own for this, I'm kind of curious how we really do stack up. Because I mean, it's an important benefit. I think a lot of times employees take it for granted sometimes. But the other side of it is that part of fixing it doesn't have to be the internal services fund. I mean, part of fixing it can be what is a mix of employer and employer and employee. And another mix in it is coverages, and how their structures and everything from co-pays to you name it, to family plans, all that kind of stuff. So, I mean, it doesn't have to be, I mean,
So
we're looking at fixing it only one way. We're not looking at some other thing.
That's, I will respectfully disagree, because we are working with the consultant on all of those things. We actually have we've been beating this to death, and we have another meeting with them tomorrow morning. We're looking at coverage levels and deductibles and co-pays and what are other counties and jurisdictions doing in terms of what do their premiums look like. Comparisons, we've done comparisons in the past, but we've asked for updated information on that. And then what is the right mix for the employer contribution, the employee contribution? If we're looking at a 20% funding increase, I am not recommending that we increase employee premiums by 20% by any means. That's way too much of a hit. And so we're working closely as a team to try to figure out what is the best recommendation to put forward as I prepare my manager's recommended budget. So we are absolutely looking at all of those things to try to resolve this issue that has been taking place for several years.
Good, I'd be interested in seeing that report. Thank you.
Kyle's gonna come up and provide a quick update on where we are for kind of year-end estimates for FY25, our current fiscal year.
Good morning, commissioners, staff, and guests. So just as an update on our FY25 year-end estimate, we are looking at revenues being 541, 537 compared to what our adopted budget is, based on our 99.29% collection rate on the property tax, and then unlikely to realize our full sales tax budget in FY25 based on the past couple of months' numbers that have come in, and I'll go through that here in a couple slides. You highlight property taxes and sales taxes because that's the largest share of our revenue in the budget. And so you can see our estimate is that we're not going to actually hit our tax number, and it really is driven by the sales taxes that you'll see in the next couple of slides. Our intergovernmental revenue is, I think, actually ticking up a little bit. As you'll recall from some previous presentations, our intergovernmental revenue has been much lower than what we budgeted in the past, and it's still off, but we are. I think it is ticking up, and actually, we was talking with Krista Smith in DSS. We think we've found something there that. So we're hopeful that this is going to improve as well, but that's where we are right now for FY25 on the revenue side. The $8 million that you see here in fund balance, we typically don't show an actual amount in fund balance, but that's really what we are estimating from our debt leveling reserves. We budgeted that $8 million in our debt leveling reserves, which is basically to cover, because of our debt service expenditures exceeding what we actually had for the revenue that is associated with those. So you do have that $8 million plugged in there. So on the sales taxes, I know this is a little bit small, but over the last 10 years, you can just see, this is county and municipality combined, so this is Forsyth County, plus Winston-Salem and Kernersville, Louisville, Clemens, Bethania, Tobacconville, and Walkertown, everybody that I didn't mention. And so you can see, over the years how we are. So while we are actually up through, these numbers are through January of 2025, so we're through, so we're into the 7 months, I guess, and so we are actually above on the on the county and municipal revenue. But when you look at these last two numbers on the far right, the percentage change, December and January are typically really strong collection months for the county. I mean, it's typically when we see significant growth. For December and January, we were down 9% and down 7%. So for the year, we're at 1.3% over. And again, this is county and municipality combined. When you look at just the county, like what we had budgeted, what you see is our FY25 budget, not including Article 46, is $89.6 million. The year-to-date budget is based on benchmarks where we think we would be. So through January, we would have expected to be at 52.2 million. And actual revenue through January is 50.4. And you can see Article 39 is about 2 million under. Article 40 and 42 are exceeding. Article 39 being under is, it's one of the things John has mentioned in the past. That Article 39 is the sales tax article to kind of focus on, because it's really point of sale, and it's also, that's where your refunds come out of, your hold harmless comes out of there. So the fact that we're 2 million under, that's what's really kind of driving our outlook right now. On the Article 46 sales tax, so you can see we had $20.5 million as a budget. Again, Article 46 is really what we give to the school system. The 25 budget through January would have been 12.1 basically, and we're at 11.5. So we were $600,000 underneath there through 7 months. And so if you remember, Article 46 revenue is something that we have. We're conservative in that budget estimate, because it does get passed on to the school system, and we don't want to get into the where we were this year actually, where the schools actually had to pay us back the money. And right now it looks like they may be in the similar situation for next year. On the expenditure side, we're at $546.4 million. If you remember in our March workshop, we tasked departments to identify $10 million savings. We got to 7.7, and it was through a mixture of freezing positions, reducing contracted services, foregoing purchases of materials and supplies, a lot of reduced training, and there are additional actions that we're taking to reduce fund balance being used even more, including appropriating some interest earnings from the Pandemic Response Fund, which is around $1 million, and then we've got some interest earnings in closing out some capital projects that we can transfer to again reduce the amount of fund balance that we use at the end of the year. I'll also say I was looking at our interest earnings for next year, like what we should project for next year, which will be lower than what we have in the current year budget. But for the FY25 estimate, it looks like it's about 1.3 million more than what I have in our projections. So that will help with our fund balance estimate as well.
Can I ask,
Sure.
interest earnings, are those fixed, or are they market related?
They're market related.
So if the present trends are what we experienced for much of the rest of the calendar year, would you expect the interest earnings to go down, up? I'm not sure what we're invested in.
We are projected to go down. I think I can't remember how many cuts we have. We have 4 cuts baked in. That we were estimating there will be 4 cuts in interest rate in the next year.
And the Fed?
Yes, that's correct. That's correct. And plus, some of our balances, in the general fund have gone down, and so, it's less money, and so that impacts it as well.
If we kind of look at the timing of when money is coming in and what rates are at that time when we're doing most of the investing, at that point, once we've invested, it kind of runs out. Now, we may go long, we may go short, but, we're most vulnerable at the period of time when we are cash flush from where rates are.
And so this is just, an estimate by object, not really by department, but so you can see, personal services, you were, about 14 million under. We've got professional technical services under, anyhow, you can see where we are, on a line-by-line basis. The payments to other agencies is largely your schools and Forsyth Tech. And then, contingency is.
Hey, something I don't remember, when I looked at that, I just don't remember in the past discussing a contingency item in our budget.
It's a budget reserve. It's contingency, what we budget in contingency includes contingency and budget reserve. We budget around $950,000, I believe, in contingency, just county contingency, and, we have not used very much of that this year. That gets reported back to you. You'll see an item in the agenda today about using contingency to, for Psych Tech.
Yeah,
Because
I did see that.
Yeah.
I saw that in looking today, and.
we usually we put money in contingency based on because they're not sure what the actual salaries are gonna be, and so we'll put money in contingency and then come back to you if we need to, and so that's what that is.
But it's from, like in Forsyth's case, Forsyth Tech's case, it's from that allocation. It's from the amount that we.
We got it carved out in contingency. We used to actually do $500,000 contingency. We bumped it up over the last several years to $950,000 in contingency because of what Dudley would call enhanced contingency, things that he thought there was a good chance that there was a chance that it would happen, like increases based on state budget for employees, or if there was maybe a possible runoff election, because we would put some contingency money away for elections, and it was in a contingency line item. It's in our non-departmental account. I can get you a full.
Yeah, I get that, but essentially in our actual budgeting process, almost within individual departments, there becomes almost built-in contingencies that are not contingencies, but they're kind of built in. I mean, it's kind of like in the past, when we've taken, this sort of, we have budgeted fund balance, in the past and not spent it. You can make a strong argument that is like a contingency in a sort. It's budgeted fund balance and it gets spent, so in a sense, it was sort of there to be contingency related. I mean, it's like what is the definition of contingency is an interesting thing.
Yeah, and it's called contingency in our system. So, but a lot of it is also really a budget reserve. So think about the airport. The airport brings in more revenue than expenditures. We can't balance the general fund budget with that, and so if the revenues budgeted are $2 million more than the expenditures budgeted, we put $2 million in a budget reserve. It's a non-spendable account.
Right.
And so that's one of the budget reserves in there.
Debt leveling plan?
Debt leveling plan. So if one of the debt leveling plans, which usually is like the 06 or 08, and also the library debt leveling plan, usually those expenditures are lower than what the revenue that will be generated by the tax rate for the debt leveling rate, and so we will put that money into a budget reserve. There's also a $2 million budget reserve. It's a transfer for debt service from the 2016 referendum that we're not going to do anymore, which I'm glad. It's also contingency, $1.8 million. I'm sorry, our prior year encumbrance number, we budget $1.8 million for prior year encumbrances, and that is wrapped up into contingency.
I'm trying to reconcile the personnel services, the staff, salaries and benefits. Information you have there with our briefing, from March, if I'm reading that correctly, essentially about, in terms of the expenditure on that category, we spent about $14 million less than we had budgeted for it. But one of the things that we were briefed on last month, as a point of emphasis, was that we were seeing less in terms of the salary savings that were expected. Is that basically because it was the estimated expenditure was substantially less than $100 million?
What I would say on the personal services is, one reason it's here is there were a number of departments when we asked them for, $10 million of savings, they don't really have that. Most departments do not have that in their operating budget, and so a lot of positions were frozen. And so I think this number is actually down from where, I'll go back and get you that number from what it was in March, because I think that number did go down, based on what they're, based on position freezes and so that's,
Yeah, it'd be interesting to know with the 7.7 million identified as budget savings, how much of it came out of essentially vacancies, unfilled, because that's a lot of unfilled, those are vacancies, unfilled positions. We're budgeting for 100% staffing, and every day somebody's not working in that position,
I wanna say it was like maybe,
accumulates.
it might have been half, that 7.7 was in personal services. So.
And then that would be about 93% of the budget, estimated for the end of the year. Whereas you look at the last couple of years, your variance there has been more like 90% of the budget.
Okay.
So you are seeing increases from, more filled positions, but still not being at full complement.
All right, well, that makes sense, thank you.
But I'll also get you your full list of the contingencies.
Before we leave the overview briefing, I remember I asked in March whether you would be able to identify the sources of the under collection in intergovernmental. Were you able to do that?
We're still working on it. Like I said, I talked to Krista Smith, and when you look at intergovernmental, a lot of it is DSS and public health. We have gone through department by department. We have and also, we do have a lot of information. I will get that to you very, very shortly. When I talked to Krista on Thursday or Friday, she said she had actually found something, and actually when I say talked, we were emailing, and it was something that was, I'm not sure if it was just miscoded where it was. That's why it may not help in the long term as far as overall. It may be getting charged, or like it might be getting coded as like another revenue or something, but and so that might impact that issue that we need to dig into. Public health is really more. It's really more on the reimbursement side, and it actually does come in much quicker. It wasn't like one of the things that I was wondering about was if it's like the sales tax calculation where that comes in 3 months behind. It's really on a month behind kind of basis, and so we're very close to having that.
But also, if you look historically, there's been a large variance there every year.
Okay.
So that's not unusual if you go back and look historically.
Yeah, and we've also had, I'm not sure how much of it could be the system change that we had where things are just getting coded differently than they were coded before. I don't know, but we are very close to having an answer for you.
Okay, thanks. I mean, just because identifying where that comes from, it impacts what we can reasonably do in response
100%.
to it.
And if Jonathan, if we've had a large discrepancy and underperformed, so to speak, in that, we obviously need to be adjusting how we budget that.
That's correct.
Correct. I
Into,
mean,
into a more realistic kind of number. I realize you can't predict exactly how much, I guess this includes, like Medicaid unreimbursed expenses, I mean, Medicaid expenses. You can't, you only have a track record of, and with Medicaid expansion, it was almost, you had no idea, in terms of how quickly more people would sign on, and then how much that would come in and be reimbursed. I can see it is sort of you're doing a lot of not wild, but you're doing a lot of guesstimating on data that's really not possible to predict carefully. But if you're always running behind, then that says, well, we need
We're
to
also
make some
working
correction.
with departments to, like, so that when we get, mid-year, adjustments where they say, hey, we've got some extra revenue that's coming in, our next question is, do we really need to appropriate that revenue? Or can we just supplant the money that we've already got budgeted? Because, if the county dollars are already there, and so if we could just reduce the amount of county dollars that are being spent, we won't appropriate that revenue anymore, and it'll just get charged to that, and that will mitigate that as well.
Yeah, that's what it, honestly, we're still doing a deeper dive to have very specific, information for you, but it seems that it's just the way in which we've been budgeting. If you look back at 10+ years, intergovernmental is one of those items that just does not appear to be budgeted correctly. I think we're getting closer to really trying to figure out how to close that gap to be more accurate. And a lot of it appears to be, we're getting in additional revenue, and every time we get additional revenue, we're automatically getting an expense with it where we could actually be paying for using the, say, state dollars to offset county dollars instead. So we don't always have to have new revenue, new expenditures. This new revenue could be actually paying for existing expenditures. And that's what it appears, a large bulk of it, which is more of just a budgetary practice. I think we're getting there.
Thank you.
And so that's gonna lead into our fund balance update. I'll hand it over to Terry, and this is actually working on this.
The arrow?
Yeah,
Okay.
the big button is.
Want to now take a look at, given all the numbers that Kyle has shared, what does this mean where we'll end up the year, and what our fund balance will look like as we come out of fiscal '25. The next 4 slides are somewhat similar, 2 different scenarios. First scenario, we're looking at the budget really more closely aligned with how it was adopted. And if we perform the way that we were on track to up until February, where we would have ended the year. And coming out of fiscal '25, if we ended the year with a reduction in fund balance of 18.9 million, which we were on track to do, and which really was in keeping with the way that the budget was adopted, and you came back and repeated the practice of appropriating fund balance to balance your fiscal '26 budget, that amount would fall into this line. The ending result, reduction in fund balance and movement of some of your fund balance up into assigned, because it's, when you use fund balance to balance the next year's budget, is no longer unassigned, it has an assignment to balance the next year's budget. The unassigned portion would drop down to 11.7% of that fiscal '26 budget, which is a violation of your own fund balance policy that chooses to have 14%. So the next look, same scenario in terms of where we end the year, 18.9, but you choose not to appropriate fund balance to balance '26. So we do have some other assignments in that number that would still be there. So then we're able to meet your 14% fund balance policy, having 14% of unassigned. But the total reduction in assigned, or in committed, assigned, unassigned, means that our fund balance ratios, as the credit agencies will review them, drops from 28.9% down to 24.5%. And that's concerning because their target really is for our fund balance ratios to be closer to 35%. Now, that 35% would be for all of our governmental funds, special revenue funds, capital project funds, and general fund.
the general fund is is definitely the largest portion. So we internally say, you know, we want to see this be closer to the 30 to 35% range because it's who drives that overall number. Also concerning is the way in which the decline has happened, because they also assess our overall financial performance, and seeing a downward trend, especially going into the uncertain times that we're facing, would raise some concern. So we took some measures to try and reduce the negative effect of fiscal '25 budget. Had some cost savings, and Kyle's estimates now show us reducing fund balance closer to about 1.9 million. Same scenario, if you come back and appropriate fund balance next year, and it moves from unassigned up to assigned, you do not meet your 14% target. And once again, although you're not hurting your fund balance ratio by as much, because you didn't reduce total fund balance by as much, you still are well below the target of where we want to see those ratios be, because we have overall reduced fund balance again for the second consecutive year. Fund balance, we talk a lot about it. We review again, why is it important? It is our savings account. It is what we have to fall back on if our revenues do not meet estimates, if unknown or unexpected expenditures come up. It provides the cash we need to operate through the first 6 months of our year, since we don't really get paid until late December, early January with most of our revenues. And it's critically important to both the rating agencies and the LGC for these reasons. Rating agencies in particular are rating our debt because they're telling investors who are getting, that are buying our bonds that may extend 15 or 20 years before they get their money back, is Forsyth County going to be good for it? Do they have the financial wherewithal to stand the financial ups and downs over those next 15 or 20 years? They're going to look at fund balance. Can we absorb some of that financial uncertainty? As far as some policy considerations, I think some of these numbers lead us to see that you want to limit the use of fund balance to sources that are restricted or committed that have for one-time purposes. So not to use fund balance, that one-time money, to pay for ongoing operational needs, because it's not going to be there before that 1 year. The unassigned cushion that we currently have, about 14%, really, if you look at the way those other numbers were falling out, we really want to see that to be closer in the 20 to 25% range, in order to give us the full total fund balance that we need to maintain these AAA credit ratings we have that looks for our governmental fund balances between the 30 and 35% range. A lot of numbers, a lot of moving parts.
Of course, one of the things we talked about was just that, essentially, we have created this PAYGO thing and named it. And the PAYGO could just become fund balance. And we just don't talk about it. We don't have PAYGO anymore. It doesn't exist. It's just, if you're gonna spend some things on whatever it is that we've used to spend it for, then you budget for it. We're gonna budget to do these things and see that your budget balances and whatever. And it's not like this, we're waiting to find out this PAYGO number and then go, yay, we can go do this. We kind of got the PAYGO thing list, which is, it's fund balance, and it needs to be, I still think, and I noticed there's some of the language, we're still sort of talking about it here in this document, and I think we ought to be thinking about not talking about it and not having it. And I don't think the PAYGO terminology or the thing itself is some kind of, any kind of policy or ordinance or anything that would do that. I think it's just a matter, we ought to make an agreement that we're not gonna do that anymore, and then our fund balance becomes kind of what that is. Typically, if you looked at 5 years worth of PAYGO and combined it with our kind of 14%, then you can come up with another percentage target. And it may be more like, I think you suggest later in here, which probably does get close to that, about 20%.
Yeah. Correct.
Well, no, I'm talking about that's your thing, but talking sort of about coming up, I think it's the same thing, it's coming up with that number. But I think we might be sort of at that number if you combine our PAYGO of the past, for the past 5 years, combined with what we're calling unassigned fund balance plus PAYGO, and calculating that as a percentage, then you know kind of what that that is. But if we still had expenditures of the things, then it would be decreasing available fund balance that we would have been spending. But I just think it's a whole lot cleaner and clearer to not have that terminology and not do it that way.
So a couple things. The current policy, which we are not suggesting to continue, states that PAYGO is any funds left over beyond the 14%. And I think that has given the board this impression that we actually have extra money. And all that is fund balance, and quite honestly, we should have kept it in fund balance, because as you can see, we need to increase it for various reasons. And so the PAYGO terminology, though, is a normal kind of terminology, but we want to more proactively budget for things we need, which you'll see kind of throughout our budget recommendations, versus hoping we have this extra money, which is really not available to do critical projects we need to be doing anyway. So I think we're in agreement, but you're seeing the terminology because it really is a real terminology that is used. But I think we're planning to try to do things a little bit differently.
And that's where, one of our recommendations had been to have in addition to an unassigned target in your fund balance policy, also a total. Because if you would have had that total policy, that total fund balance level in your policy, exactly what you have said would have happened is you would not have had the PAYGO, because you would not have been meeting your total policy. So you'd have to meet your total policy in order to have used those excess dollars. And in the last couple of years, you did not have those dollars.
That seems to be a key change that needs to happen in the presentation to what we're dealing with.
Yes, is that total target is critically important.
And really, that does fall somewhat into the unassigned, because the restricted and committed do have purposes. A large part of our committed is debt leveling, and you are gonna want to use it as that debt service becomes due and payable. So we really are looking at the higher level of unassigned that we want to keep, which of course would increase total fund balance. I think we're ready to move into our financial advisors, deep dive into how the credit rating agencies review us. If you want to move into that, you want to take a little bit of a break?
Do you want to take a break, or do you?
What's
Mr. Chair.
feelings for
Mr.
break?
Chair, time for a break.
Thank you, Ms. Elizabeth.
Even from home.
Even from home, she's getting us honest.
That's good. All right, let's make it about 6 minutes.
Thanks, Ms. Elizabeth.
Take advantage of it. I'll turn it over to you to introduce our, yes, first try.
Thank you. Good morning, everyone. I'm going to have our Deputy CFO, Lee Plunkett, introduce our financial advisors.
Chantel, good morning. So we have with us today First Triad Advisors. They serve as our financial advisor for debt-related issues. They've been huge in a lot of issues that we've dealt with lately. Obviously, our ongoing debt, they help us out a ton there and guide us through that process from start to finish. But they also help a lot with modeling out for additional capacity that we're providing to the schools that we're kind of in the middle of. The whole issue with Fitch and the way they changed their methodology, they guided us through that, helped us map out a plan. And if you remember David Cheatwood and Chazo Halliston, they were here when it was about a year ago to talk about Fitch and kind of walk through that in front of you. But David's been with the firm for 10 years, and then Chazo's been with the firm for 6 years. So they've been huge partners with us. So I will turn it over to them and let them get into the meaty stuff.
Commissioners, good morning. Thanks very much for having us here this morning. As Steve said, I'm here to really do a deeper dive and piggyback on some of what Terry described about your fund balance situation and really focus on your credit ratings. We have a couple of pieces of information we'll get through as well, but I'll jump right into it. I know, again, last year we talked about focus mainly on the Fitch rating. We're going to talk more about the Moody's and the Standard & Poor's rating this go around. So, current snapshot of the county's outstanding ratings. Again, you have 2 credit ratings now, one from Moody's and one from Standard & Poor's. You are AAA from both Moody's and Standard & Poor's on your general obligation bond rating. The county also has limited obligation bonds outstanding. Those are rated 1 notch below your general obligation bond rating. That's the standard because they're subject to appropriation, not pledging your taxing power. Your LOBs or limited obligation bonds are 1 notch below. You were last formally rated almost 2 years ago in connection with your last bond deal, your 2/3 GO bonds and actually referendum bonds from 2023. And at that time, again, they affirmed your AAA ratings. We're going back before them in a couple of weeks. You've got a bond issue, as you'll know, coming up, another 2/3 bond issue, and so we've got some rating calls scheduled in a couple of weeks with Moody's and S&P. Just to summarize, in their rating reports, which they put out every time they rate you, they mention some strengths and challenges. And so from a strength standpoint, regional economic center with institutional presence, manageable long-term liabilities. From a challenges side, and we'll get into some of the minutiae here when we look at the different rating scorecards, below average income and wealth levels, moderate overall debt position. You don't have an upside scenario with Moody's and S&P because you're already AAA. Your downside scenario, if you have a trend of structural imbalance, if you have a significant increase in your long-term liabilities or weakened economic growth.
Can I ask you a quick question?
Yes, sir.
That slide. And sort of just, there's probably not a single way to describe this, but on the little chart there to the right that shows the ratings as they go down from great to AAA to triple B with a B minus. What is sort of the difference in borrowing rate for us? Is it roughly so many basis points per drop?
Yes, sir. So, general rule of thumb, if you go from AAA to AA1, it's anywhere from 0.03%, 3 basis points, to 0.05%. And that's, it starts to widen out. The 1 notch per starts to widen out as you go further down the credit rating spectrum. So for instance, if you were going from A1 to A2, it'd be closer to 10 basis points, 0.1%. If you're A2 to A3, it may be more like 0.15. And so if you're at the very top, the difference is relatively small, but as you go further down, that widens out a little bit each notch you go down.
Got it.
And then obviously you take that, the actual dollar difference depends on how much you're borrowing, but that's the interest rate difference.
Yes, and 0.03, and 0.03 is not gonna be huge, but if it's big dollars, it's still nice.
That's right.
Exactly. Sure, thank you.
So I wanted to take you through each of rating agencies' rating methodology here. You'll find some common themes. They're generally focused on the same 4 things: your local economy, your financial performance, management, and then your debt position. Debt to include outstanding debt, pensions, and other post-employment benefits. So For Moody's specifically, 30% of your overall score is related to economy, 30% financial performance, 10% institutional framework, and 30% leverage. And within each one of those factors, they have sub-factors. And so this is where Moody's and S&P are great. They're very clear cut on how they rate you. Here are the factors, here are the weighting they assign each factor. So we're able to replicate their scorecards. So that's what we've done for the county, so that we can run some sensitivity analysis as we go through some different options here. Maybe easier to see in your sheet versus on the screen, but this is your scorecard as we calculate it based on your fiscal 24 audited financial statement. So your last audit, we're dropping that in, as well as your most recent economic numbers. And so I want to take you through each of these factors. For the local economy, 30%, the 3 sub-factors, resident income. The way to read this, that's a 10% of your overall rating. How you grade out from a value perspective, 91%. And then ultimately what we're focused on is this far right column. So each individual sub-factor, they're grading you on those. And then that's going to lead to an overall score. So when we look at the far right-hand column, again, AAA being the best, you'll see that your local economy scores, which consist of resident income, your full or market value per capita, and economic growth as compared to the United States, those are anywhere between A2 and AA3. And so those are kind of more mid-level on the economy side. Your financials consist of 2 sub-factors, fund balance and cash or liquidity, and that's worth 30%. And you'll see from a fund balance perspective, based on your fiscal 24 numbers, a AA2, and then a AAA on the cash side. Your management, institutional framework, all counties in North Carolina get the same grade for this, and this is a AA2. And then your leverage, which counts 30%, they have 2 ratios they're looking at, long-term liabilities and fixed cost ratio, both of those AA2. When we look at these rating scorecards, I like to group them into 2 different categories: things that you as a board have direct control over and things that you really don't have direct control over. So when we look at the economy, you as a board don't have direct control over that. From a longer term view, you do if you're bringing in certain industries that have higher paying jobs and grow the assessed value in the area, et cetera. But really, when y'all look at board control, it's the finances and it's the leverage metrics here. And so those are things that if you wanted to, you can make decisions that improve those, or you can go the other way as well. So the punchline on this slide, and this will carry forward into the next couple, your total score from this scorecard is 3.45 based on all of these metrics. When we look at this grid here at the bottom right, you'll see that that 3.45 puts you in the AA2 category purely from a scorecard basis, which is the starting point. And it's actually at the low end of the AA2 category. And that's driven, again, in part to the economy side, but then also a little bit on the fund balance and debt metrics there. So when we look at how you've graded out historically, to put this into context here, you've been back in 2022, based on your fiscal 22 audit, you were 3.45 as your score. You improved a little bit based on your fiscal 23 audit, as you had a couple of metrics, couple positive metrics there, and then we went back down to the 3.45 based on your fiscal 24 numbers. So, on the one hand, y'all are in the same position as you were a couple of years ago when Moody's last rated you, same overall score. However, that's where, since this is their starting point, they go to refresh this, which they do this time around. Especially when we look at some of the potential sensitivity, looking at the fiscal 25 numbers, you're already scorecard towards the bottom of the AA2, so the argument gets a little harder to maintain. The case for the county to maintain you at AAA is more problematic. It's harder if we're going the wrong direction on that. And we'll show you the sensitivity specifically related to fund balance. So while you've been AAA, and this is where Moody's, they have the ability to do these below the line adjustments, and so they've kept you at the AAA level when they've reviewed you. They haven't specifically noted, here's exactly why I'm bumping them back up to AAA, but they've leaned on the economic presence in this area, and so that's one thing they're focused on. But they also look at peers, and so your peers across the state and the country, those other AAA peers, and so if the county's kind of staying static with its score, others are improving, again, it makes the case harder for, to maintain the AAA. So, again, the purpose of a lot of this discussion is to flag some of this for you, especially as we get into these discussions with the rating agencies. So, wanted to do a sensitivity analysis here based on some of these numbers. I know a lot of numbers here, I'll point you to a couple things. So what we wanted to look at, piggybacking on what Terry just went through, if we fast forward and look at your fiscal 25, and the only thing that we adjust is that you reduce your fund balance by 18.9 million, which was that first scenario that Terry laid out, then that's obviously gonna have a negative effect on those couple of financial factors there. And you'll see that your score would go from 3.45 to 3.65. So now we're getting into the AA3 category. Again, makes the argument a lot tougher to maintain the AAA there. And that's just moving one variable. There's many factors as you saw, but if we focus on just that factor in that first scenario, that lowers your score. Now, if we then take into account that, let's move another variable here. Let's look at the debt metric. Y'all are issuing 2/3 bonds coming up, which means you've paid down, or you will have paid down 1/3 of your outstanding debt. So that's a positive. Even though you're issuing new debt, you've paid down a good amount. So that slightly helps you and gets you back, lowers better, I should say, as you know from looking at this grid here. Goes from a 3.65 to a 3.57. So that's positive, but again, not enough to dramatically move the needle here. And then if we fast forward and go to 2026, we assume you drop the fund balance by 18.9 million in 2025, and then you hold that steady in 26. So there's no change in fund balance from 2025. However, you've got your reval coming up. That's projected to increase that by your assessed value by 40%. That's a positive. That's one of those, that full value per capita metric. And so that's going to go up. And so that would help your overall score and take you to a 3.31, which again is moving in the right direction. So you've got some good things on the horizon, particularly related to your assessed value increase there. But that fund balance drag is going to keep you, is going to hold you back from really moving further up this spectrum, which again helps your argument maintaining the AAA. So I know a lot of numbers and variables here, but really wanted to focus on the sensitivity of that fund balance. And if we get the 25 drop, that's going to make your score lower there. That is something to last. Again, we're talking to them a couple weeks. They're going to say, how's fiscal 25 going? What do you expect year end? We're mid-April now. Where do you think you'll finish up? So that's definitely a question they'll ask. Moving to S&P, and I'll go through this one relatively quickly here. Same general factors they're focused on: local economy, financial performance, reserves and liquidity. They split that up into two, whereas Moody's had the kind of financial all under one roof. Management, and then debt and liability. So again, generally looking at the same factors, slightly different metrics and different weighting. But going through the S&P scorecard, the county grades out at a 1.6, which the way to read this chart, all North Carolina entities start on that top line, that number 1 line. And so your score of 1.6 would put you somewhere between the AAA and the AA+, closer to the AAA though. So per the Moody's scorecard, y'all grade out closer, very close to the AAA metric. When you look at the different sub-factors here, or the different factors, you'll see the highest weighting, which is the lowest overall score, is the economy, because again, they're looking at some of the same factors that Moody's did as well. But all your other metrics are really positive. Debt's a little bit elevated based on their metrics. But you do from a scorecard metric grade out very close to AAA from S&P. History here, y'all been steady from S&P on that side. Their fund balance metric is a little bit different than Moody's. Their bar is a little bit lower to get a higher grade from them. So that's one thing to focus on when we look at these different metrics. You may say, well, how are we getting a really low score from S&P, or positive, good score from S&P, but not from Moody's? Slightly different metrics that are looking at. Same sensitivity here. So we start with your base scenario at the 1.6 overall score for fiscal 24. If you have a drop of 18.9 million in fiscal 25, your score is going to go up, which is not a good thing. It goes to 2. Now we're getting a little bit closer to the AA plus, or really right on the AA plus category here based on fiscal 25 and that reduction. And that stays that way even with the debt roll off. And then if we fast forward, similar to Moody's, you get a little positive bump with that assessed value growth. But if we still have that fund balance reduction that we've then carried forward with the flat 2026, we are worse than where we are today on that. So again, I'll maybe pause there for a second. I've got a couple other things that are, I can go through quickly that are not related to the credit ratings, but happy to take any questions y'all have on just the two scorecards, the factors they're focused on, how the county grades out, and the sensitivity.
Yeah, if we were to actually, you know, we're not gonna get to the 18.9 this year. I mean, that's clearly not gonna happen. And I guess back on the sensitivity side of it, how much is that likely to improve? I don't know how those little 0.6s and 0.5s and 0.4s are, what their whole, I guess how they calculate that.
So if we look at kind of the difference from 24 to 25, and the one we're more concerned about is the Moody's rating. Going from 24 to 25, that 3.45 to 3.65, which is the full 18.9 reduction. So rough math, if you kind of had half of that reduction, you'd be somewhere in between the two of those. So roughly a 3.55. Still, again, not in a positive direction. And I think that's the thing, you know, that concerns us. We've stayed at the score. If we go a little bit lower, we're not showing that trend up. If we can say, listen, you graded us at a AAA 2 years ago at a 3.45, and now we're at a 3.35. So we're going in the right direction. So keep us at a AAA because we were there 2 years ago. If we're going the other way, again, that makes it harder, especially if your peer counties, the Wakes, the Mecklenburgs, and Durham County, et cetera, they're going up and they've got stronger metrics there. And national, they don't just look at North Carolina, they're looking at AAA medians across the country.
But I assume in like the upcoming sale, which is right at the end of FY 25, obviously as they look at this, they'll know about the reevaluation.
They will, and we
so,
will definitely.
Knowing that gets us, that's a big improvement, and if we get a pickup, that could get down to 3.2, which would be an argument for maybe maintaining the AAA on this coming sale, a medium sale.
That's absolutely something we're gonna emphasize. Hey, it's not in these numbers yet you're not gonna see in 24, not gonna see in 25, but in 26, you will see that. That's coming, and that's factual. We know that. And so that's where, again, that scorecard is their starting point. So when they do some of those below the line, I'm sure the analysts will do that sensitivity and drop in your 40% increase to see what that does. What would be great is if we can say, we've got that coming, and from a fund balance perspective, we've held steady for fiscal 25 if we can get there, or we're looking at trying to grow that, concerted effort to grow that in fiscal 26. So those are those kind of below the line adjustments that we can emphasize as we're talking with them to make the case to stay at AAA.
Thanks.
And I did forget to mention, we dropped in their full presentation in your packet. It'd be probably the last one in your
Good,
packet.
I saw there was an appendix reference in the
Yeah.
slide, so.
So all the calculations are in that, they provided the calculations for us, so
Good.
if you do wanna look into that, it's in
Thank you.
your packet.
And one thing I didn't point out, if you look at the, I'll mention one last thing, on the S&P scorecard, again, if you dig into any of the numbers in the back, when we look at this sensitivity, you'll see the one that's changing, the negative here with these fund balance reductions is actually the financial performance, not the reserves and liquidity. And the reason for that is even with reduction, again, S&P has a slightly lower bar for reserves and liquidity, but the financial performance, they're looking at a 3-year rolling average. And so you've graded out nicely because you'll have a really good year in fiscal 22. You added fund balance. 23, I think, was a slight add, and then 24 was a draw. We have a draw in 25, so we're rolling off a good year and adding a not so good year potentially. So that's why that financial performance metric is the one that's going down as opposed to the reserves or liquidity. Yeah. But yeah, a lot of good detail in the back if you care to get into the weeds on it. Two other quick hits here. talking about your debt leveling plans. And so looking ahead for fiscal 26 with the reval, you've got the 40% increase in your assessed value and therefore the 40% increase in the value of the penny. So going from approximately 4.5 million to 6.4 million value of the penny. So with that, you've got the option to make some adjustments to your different debt leveling plans. In your current year, fiscal 25 budget, the county's allocating 11.5 cents to its 5 different debt leveling plans. We've got a model built out for the counties to where we can look at, with that growth in the value of the penny, what can we lower those tax rate allocations to and still maintain a positive fund balance in those individual debt leveling plans in order to make your remaining payments. And based on our math, you can lower that by about 2.15 cents and still have sufficient revenue coming in to make those payments for each of those 5 debt leveling plans. So that's a look ahead to fiscal 26 for that piece. And then if we take a couple of years down the road and look at potential capacity for new debt, a new GEO referendum perhaps, you've got 2 debt leveling plans, your 2006 and 2008 for education that are rolling off in increments in 2028, 29, 30. And so if we grabbed a little bit of that roll off, not all of it, but if we grabbed 2.45 cents between your fiscal 29 and fiscal 30, when those 2 debt leveling plans roll off, how much capacity would that generate based on, again, we've increased your value of a penny with the reval, a slight assumption for slight growth going forward. Our analysis shows that if you take that 2.45 cents over that 2-year period and keep that for a new debt leveling plan, you'd have capacity for about $300 million of new bonds, $330 million of capacity. We're making some assumptions on the debt side that you issue it in 4 tranches at a certain interest rate. But you've got good news on the horizon from the debt perspective because you got some of this debt rolling off, and if you repurpose it, then you've got capacity for new debt. So, and that's really, again, with your 2/3, you're paying off debt at a pretty rapid level. All of your debt's 20 years level principal, and so with these, with the debt rolling off, it naturally generates capacity for new projects going forward.
Can I ask you a quick question? In your assumption of a 5% tax-exempt interest rate, that seems really high right now, and I realize, but you're looking here 2030 kind of numbers, 2028, 30. Are you being sort of conservative, or are you being not?
We are being conservative. Generally, the longer out we're looking, we're going to put more conservatism in there. I would say with all the models we do, we're generally not going to assume a rate higher than 5%. Municipal rates haven't been higher than 5% over 20 years. And we've got an update on the proposed borrowing for 2025 and where that rate is, and I'll go ahead and note it's about 3.75%. So as of today, really as of last week, you've got about 1.25% of cushion based on all our analysis there. But again, to your point, this is dead 3, 4, 5+ years down the road. So we want to build that in because as y'all have seen from the news, there's a lot of volatility out there. We don't know where things are going. And actually, to mention this last point here, one thing that's been in the news is just tax exemption in general, and is that going to stick around, or will they take that away? That's obviously very important for everybody in the community, and that's very impactful. And so we ran an analysis. If instead of the tax exempt rates, you had taxable rates, which are generally about 1.5% higher, that would shrink your capacity for new debt by about $40 million. So it's real money, it's a real difference, and so that's why there's so much from a lobbying effort to make sure that state, local governments, and everybody else who has the ability can keep that. So that's very important there. But generally speaking, we have conservatism in the rate. You're a ways out, and there's a lot of kind of unknowns out there, so that's why we've kept that.
No, that's good.
What we normally do when we're working with Lee and Terry on the model, if we've got a borrowing coming up that's in the near term, we'll shrink that cushion some. So we may dial that back to 4.25% if we've got a borrowing in the next 6 months, for instance. But if we're looking years ahead, we'll keep that 5. So speaking of your upcoming bond deal, there's a graphic here I'll kind of touch on. Actually, I may just hit one interest rate graphic in the interest of time. Looking at the tax exempt benchmark yield curve, just looking at we've got the 5-year rate, the 10-year rate, the 20-year rate. I'll just focus on the 20-year rate, which is the blue line. We had a very long extended period of low rates. That ended in 2022 when rates shot up, so you'll see that big jump up in 2022. We actually reached a 15-plus year high in rates in fall of 2023. Since that time, rates have come down. However, this year, calendar year 25, has been very volatile. Rates increased in January, February, came back down a little bit to start March, but over the last couple of weeks, it's been very interesting. They went up, and then they've come back down last week with the implementation of the tariffs. Stock market getting crushed. Typically what happens when people are taking money out of stocks, they put them into bonds. That helps lower yields. So the silver lining, even though your 401k is getting crushed, well, when you go borrow, the borrowing rates are better for you. So that's where we are right now. So we've seen a little bit of dip here, and this is over the last couple of days. So looking at where you are right now on your borrowing, your 2/3 capacity is $33,635,000. You've got the 4 different categories there that for the funding needs: schools, community college, parks and recreation, and then just other county improvements. That's where the funds would go. And based on current market rates, as of a week or so ago, you'd be at a true interest cost or a blended cost of 3.76%. If we ran that today, it'd probably be a little closer to 3.65. So very good rate. We've kind of been, for the deals we've been working on, anywhere from a 3.4 to a 3.8 or so over the last few months, so it's been in that range. Last slide here, next few steps. You've already taken initial action as a board on these bonds. You've got your second and final action coming up later this week, where you'll adopt a bond order, hold a public hearing, and adopt a sale resolution. As I mentioned, we've got rating calls coming up in a couple of weeks with Moody's and S&P, and then you're on the calendar with the local government commission to sell those bonds on May 20th, and then close June 11th. That's when the money would be in the bank. So we're well into the process here and getting close to that sale date. Any other questions?
I have a more general question about I guess it was mentioned earlier, there are like 3 different fund balances that are sort of that, I guess it Moody's is looking at. And you mentioned one is our general fund, one's capital.
I'll mention, so they look at 3 different categories. Moody's looks at 3 different categories. They look at unassigned, assigned, and committed.
All right.
And then they're looking at those across really all of your funds. Your general fund is your biggest, but they're looking at across your other governmental funds, and then they actually look at your internal service fund, a couple of the proprietary funds as well. So Moody's, and this is as of, they revised their criteria a couple of years ago, but they're looking really across the board at all of your fund balances to get to that aggregate level. And then they're taking all of those fund balances and dividing it by revenues across all of those same. So, but again, the general fund, the county's general fund, is going to be the primary driver of that, since that's where most of your dollars are. But they're looking at committed, assigned, unassigned.
So, the 35% is all 3 altogether.
All 3 altogether across all your different funds, divided by all those funds' revenues. And that 35% is to get the top score, going back to that scorecard where you, based on your fiscal 24, your fund balance metric was a AA2. To get the AAA, that's where if you have 35% or greater, you're getting top marks for fund balance from Moody's.
And is that looked at, do they look at that over time? I mean, on, like, if you get ready to, if you only sell, obviously the philosophy of selling bonds here has been to do our 2/3 bonds, selling stuff every 2 years, but just take this as a hypothetical. What if you're just selling bonds every 5 or 10 years, for example? Well, even in our big, I'm thinking like school bond issues, which are our big ones, we are selling tranches, like we're selling it 4 times. And that was part of your assumptions in your rate, in your whole sort of looking ahead.
Right.
I'm just trying to get at, if there are anomalies in fund balance in a given year, is it looked at over a time period? Because you mentioned, I think, on the S&P, it does look at a 3-year rolling average. It sounds like in Moody's, they're looking at 1 year at a time.
They are.
The current year you're getting ready, and I assume that 1 year is the year you're selling.
So they are gonna start with your most recent audited statement. So they're gonna start with your 24 when we talk to them in a couple of weeks. But then they're gonna say, we're in mid-April, how is 25 going? And that's where they can make adjustments based on that. So if we say, I know this is in worst case not gonna happen, but if it's a $20 million draw on that, then they're gonna go in just like we did and lower that fund balance to see what that sensitivity is, since you're so close to finishing the year. Now, they are gonna rate, so yes, Moody's is looking at spot, but then spot fund balance, but then they can make those adjustments. And so that's where that below the line kind of flexibility comes into play. The scorecard, and they'll tell you this too, that's their starting point, and then they make adjustments from there. But they will rate you, whenever you do a bond issue, they're gonna rate you, and then if it goes a couple of years and you haven't issued bonds, they'll still do annual surveillance. That annual surveillance doesn't always involve a full credit review and rating opinion, but generally every 2 years, even if you're not issuing bonds, they're gonna do an update, release a report. And so they have a duty to the investors that hold your bonds to keep up with your credit rating. So they are doing that internally on an annual basis. The county may not recognize it, but maybe every 2 years or so.
Got it, that's good, thank you. Any other questions? And I appreciate that appendix. I have just more of a curiosity question to look at some of those, but I was just, good.
Thank you.
Thank you. All right, next up is, Kim Bussey, who's gonna talk about, our capital. One of the items you will see in the recommended budget will be surrounding really trying to tackle our deferred maintenance needs in the county. And part of her presentation will bring up Lee, who will talk about just kind of how we can finance it.
Good morning, Commissioners. So, that's right, we'll talk a little bit about our capital improvement program and where we are to date. High level look at the goals for this new CIP. There are two big ones. One is to approve a 6-year capital improvement program. That really goes into detail about the projects that are included for the next 6 years. This is gonna include, we've talked a lot about maintenance projects. This is maintenance and new construction projects, all rolled up into one, particularly for the county, but also for the schools. And note that the 6-year plan is not a static planning tool, and it will be evaluated every year and brought to you in this way for hopefully some greater planning and some consistency across fiscal years for what these projects are and what our needs are moving forward. The other big goal here, ideally, is to adopt a capital budget ordinance along with the fiscal year 26 general fund budget ordinance that you're used to seeing. So we'll have a 6-year plan for you to review. It's that year 1 of the plan that will be included in the capital budget ordinance. And again, this is to include those projects and those identified funding sources for that year 1 in particular. I think the conversation about this chart has been very relevant so far. This is our PAYGO amount. This is our cash available funding that has been identified by that fund balance policy over the last few years. This is unassigned fund balance in excess of 14%. So our policy says this is what we had available at those times. We've used that funding for capital and economic development projects. And I think the takeaway here today is that it is unlikely that this will be available moving forward. Certainly not at this level, but even if there's a change to our policy and to reassess where that threshold is for our fund balance, and to shore up that fund balance, especially in this next year, this $7.4 million they need to go to that purpose. And so that's kind of the takeaway I think you mentioned earlier, is that this may not be available, so what do we do moving forward to fund our capital projects? We hope that this new approach to the CIP will replace that PAYGO chart and that process with a proactive funding mechanism for all of our county projects, for all of our capital projects, period. Deferred maintenance, we talked a lot about during our winter work session. This will continue to come up. And the goal is that we can address those deferred maintenance projects both through a proactive funding mechanism, but that we don't get in this position again with some proper planning as we move forward and have some of those not new and shiny new projects, but also those, sorry James, fairly boring maintenance projects that are included in those through the next 6 years. So hopefully better planning, we won't get in that position again. And then that we can evaluate those funding needs in the context of our general fund budget. That's an important component here. And that this process, this capital improvement program, the development of it, and to present it to you in this way, hopefully we can get some feedback on this plan and the projects and the funding proposals as well. We talked a lot about maintenance needs. As a reminder, this is, I say, a conservative estimate, especially for general services, a little bit of parks. That Forsyth County manages over 2.5 million square feet of facilities and at least 39 facilities. The average age of those buildings is 36.18 years. And you'll see the graph at the bottom that those facilities have continued to increase over the last few years. And they will continue again in fiscal year 26 as we add English Cottage comes back on into our maintenance care and our new agriculture park facility.
But I assume, for example, that includes the old courthouse.
It does, for now. So that will be.
Whatever it is, 160,000 square feet or whatever kind of big piece, which hopefully it'll be gone and probably there may be some other facilities that'll be disappearing.
Agreed.
In the future, and that's important to kind of know and to factor in sort of our big thinking and all that kind of stuff.
Absolutely. And so while we have had a net increase of our facilities that we have to maintain, as a reminder that our capital maintenance funding, especially for those 2/3 bonds levels, have not changed for the last few years. We've been at $1 million for our county capital maintenance and $1 million for our parks maintenance since 2017.
Just a general comment, you know, some of this work that we've done, just like the new courthouse, like we're gonna be able to do the ag center, like the new clubhouse out at Tanglewood, like, we've done some new stuff. So from a long-term capital maintenance financing, that's reduced our costs substantially, because they're starting over at square one, so all their HV systems, all that stuff is new, you know, and they're actually more efficient. There are a lot of other things that kind of go with them, which are all good things. That also impacts, I mean, I'm kind of on this kind of stuff that is really helpful to have a list of kind of the year that buildings were constructed, that kind of shows every building when they were built, and it shows every time major, and that becomes sort of that kind of becomes your Bible for going forward to taking a look at what you're gonna do. And I don't sense, I'm interested, I looked through this, and I'm just interested in more granular detail and more sort of, this is too high level with lots of big sort of chunk, sort of estimates of cost too. I'm interested in a little more, and of course, you do that in your 1 year that you're getting ready to go forward on.
Right.
And I realize the big picture is probably, it can be much more general, but.
So we had a facilities assessment done, what year was that? James, what year was that?
I believe it was 2016, 2015, somewhere in that neighborhood.
And we've done nothing with it. I mean, we paid for a facilities assessment, it told us what our deferred maintenance needs were, and we did not fund it. And so, what we are trying to do is, those projects didn't go away. So I hear you on some of the newer projects, we certainly are in a better place, but we've not really taken care of a lot of the older items that was identified in the facilities assessment. Quite honestly, we need a new facilities assessment, but those items didn't go away. And they were identified with no funding, and even though we had PAYGO, we added new shiny things. We didn't use most of those funds to actually address the real deferred maintenance needs. So we can get you all a copy of that facility assessment. The other thing, I will mention is that even in some of the new buildings, we face some challenges, especially on the HVAC side. And that's more of, I think, an assessment of us to make sure that we are making sure we're getting HVAC units that we can actually maintain.
Yeah,
and not have
it's back to
units.
standards.
Yeah.
You
So,
have standards for things.
Correct.
It's like you almost have a book of standards.
Correct. So
The
just
things.
because I would say, while new buildings have helped, the new buildings have not completely done away with maintenance needs that have also come up.
And we're planning 6 years plus in the future. So I think just to be, we're having those new buildings come online, but let's make sure we're planning for the time when those maintenance needs are gonna come up with those projects.
Yeah, cause I mean, it's questionable about Kernersville and the library at Kernersville. I mean, that's a brand new facility, and not to be able to utilize it because of the HVAC system is unacceptable.
And that's, but it's gotta be, I'm still baffled about that. It's gotta be one of the issues on this. I mean,
I don't know.
Well, there's a whole lot with that particular issue. Part of it stems from, we got an HVAC unit that we don't even know how to maintain. We've never had that unit ever before. Our folks didn't know how to do it. The warranty period expired. We've had the attorney's office involved. I mean, there's been a lot of stuff on the HVAC unit with Kernersville. Part of it is certainly on the contractor. Part of it is, again, some of our practices of how we decide to put things in. Kyle Denise and I went to Kernersville Library last week, and it was working, and the staff said that it's been working for.
It was also mild weather last week.
No, it was the most, we were there the most humid day of the year thus far, and it was holding steady at the time. But there's a lot that goes in.
But I like the theory that we're gonna connect those facility assessment data to this plan and to move into that way. And I think we've done a lot of work, especially with general services and working with parks too, of getting to making that connection from this facility assessment, which really looks at every building, facility, piece of equipment, and really tells us the roadmap for where we need to be and that we can plan for that in this process. So whatever the level that turns out to be, that's the goal, is to connect those two that way. And I should mention too, in front of you, you have a packet there. And Commissioner Martin, as you said, you've got it starts with a high level look of those projects in larger buckets, which we'll call project types, which we'll look into in a minute. And then they get into each of those projects that fall under those project types. And then it also looks at those projects in terms of deferred maintenance. And so if they've surpassed that time frame that General Services has identified as the time to replace those facilities or pieces of equipment, then it'll fall on that deferred maintenance list.
And it's this packet that you want.
And I would say refer to that as we, the next few weeks too. If you have questions about specific projects, please don't hesitate to reach out and get certainly more information about each of them. No. Perfect. So to continue on the line of our capital maintenance needs theme here of this program, the Law Enforcement Detention Center, as a reminder, is 33 years old. Public safety maintenance requests that come into our facility make up 45% of total maintenance requests. And of the sheriff's office projects that are included in the capital improvement program that you'll see in just a minute, 66% of those projects are considered deferred maintenance. And that's a really important building, that Law Enforcement Detention Center. That's certainly a building we don't want to get in a position where we're in trouble there. So, and then just countywide deferred maintenance in the CIP totals over $33 million. So, we're going even bigger picture now to take a look at the CIP structure. Again, this is the first time you're seeing this in a full picture, and so I just want to make sure that we're clear about how this is being presented today and as we move forward. So the development of the CIP has been done in the last few months. In February, department submitted their new capital project request, and we told you that we've been working with them on their maintenance needs. Budget, General Services, Parks, and County Management have reviewed these projects and really tried to get what are these essential projects that need to be done in the next 6 years. We still need additional information from the schools, and both Forsyth County Schools and Forsyth Tech. We have some project information, but I want to get a little deeper into their 10-year capital plans for both of those
I was gonna say that, I believe it was Commissioner Bessie who asked for that capital improvement, notification from the Winston Forsyth County Schools, and we still are waiting for that.
We are still waiting for it. I know they're working on it and hopefully we'll have it soon, but I do not have it yet.
Let me ask this question before you leave that slide. So departments submit these capital requests and maintenance kind of things. Got it. And so in the review of that, I'm kind of curious, in the review of all the projects, how many of them got weeded out or moved way out to the bottom of the, I mean, because when you ask a lot of people, departments, kind of their stuff, they ask for a lot of things.
For the new projects in particular, yeah, and we'll talk about, I think it's the next slide that goes into what's included in the CIP and what are considered horizon projects. And a lot of those new projects you'll find in the horizon project list, that we want you to see, we want you to be aware about. If there's, policy conversations to be had, if there's interest in adding them onto the CIP, we can do so, but a lot of those will fall there. And then as far as the maintenance needs go, we've done a lot of work with the departments to say, let's prioritize what has to be done. What is a deferred maintenance project that we need to do for safety, for some, the cell floor project in the jail, we talked about those. They need to happen. And so there's been a little bit of both, I guess, for the maintenance and the new project evaluation.
So for me, with the Winston-Salem Forsyth County Schools, I think the timeline would be helpful as well in terms of knowing how long these facilities are needing some improvement.
Absolutely.
Yeah,
absolutely. It's important to know the airport projects are not included in the CIP that you see today. We're still doing some more, some work with those projects. We've got a lot of money allocated to the airport, a lot of projects, and we're kind of seeing what grants we've received, what projects have happened, which ones haven't, and once we shore up where we are with the airport, we'll add them to the CIP, but we do not expect any new county dollars to be needed for those projects. They've got their airport, I think, funding pretty well squared away, especially for fiscal year 26. So when we're looking at this big picture, we'll look at several categories that are included in the capital improvement program, and then, like I said, some that are not, that will be considered horizon projects. Today we're going to talk a lot about the county capital improvement category, which is maintenance of existing county facilities, new facilities, renovations, all in order to keep and meet that service demand. And then the other two categories, one for Winston-Salem Forsyth County Schools capital program, or capital projects, and for Forsyth Tech. The fourth one you see there, the Fire Tax District Capital Fund, is not included in the CIP right now. We did just want to mention it, that there is some evaluation work going on to see if this is something that, if there's benefits to including this for our county equipment, but just wanted you to kind of see it and be aware that there's an evaluation.
Let me ask you a question about technology. What technology is listed in the school district in Forsyth Tech, but is not listed with ours? We have a lot of technology too, and so I'm kind of curious where it is.
That's a miss. Technology is included when you go, she has 2 slides, and it is in our project type.
Right, and automation technology needs for the county as well. We'll talk about that a little bit as well. And then again, the Horizon projects, which we'll see, they may not have made it into the capital improvement program for a few reasons, that they're, again, a policy discussion with the board. There might be a lot of factors in the project to say, well, this needs to happen before this can happen, and so the timing may be off for this fiscal year in particular. And then again, everything has to be, funding source needs to be identified, and so it may just be that the threshold for the funding isn't. Wanted you to see this chart because we will see it again in the future, but just know that as we get information from the schools, that these numbers will be updated. Just to give you an idea of a similar proportion from what we've been in the past for our capital funding. Do expect this to be similar, but know that we'll update those numbers as we get the information from the schools. And again, thinking about these categories in the CIP, this lists them again on the left. In the center, it talks about probable funding sources for each of the categories. And in particular, the column in gray gets to those big buckets we keep talking about. These are our project types for each of the categories, and so a way to bring those projects to you to include in our Now we'll look a little bit deeper into the county capital projects. And again, you've got lists in front of you, and stop me if there's something you want to look into further, and we can certainly give you more information in detail and can send it to you another time too. So the first sheet that you see in your packet is a summary of the capital needs from a 6-year perspective. This total of $85.6 million, and for the fiscal year 26, you'll see a total of $15.6 million for 26. Again, this is maintenance and new projects that have been included in the CIP. Since we're focusing on fiscal year 26, and that's the budget ordinance that we want to see, and the funding that we absolutely need funding for the full 6 years, but the funding we absolutely need to see in 26. This gives you another look at that, at 26 levels, by project type, and then here, what we've considered departments. This is by element. This is another way to group the projects that you're gonna see, and I think it's relevant to show you that the sheriff's office projects totaling $10 million, by far the most, that really lends itself back to that, those maintenance needs, really the LEDC, but, and you'll see that a little bit as we move forward into those major capital projects. So now we're gonna go through each of these project types. We can do it quickly. Like I said, let me know if you wanna stop and look into something a little in more detail. But the first project type is economic development. So there's nothing listed for fiscal year 26, but a total of 1.2. This really gives a placeholder for future economic development projects. Historically, they might have been smaller projects out of the airport or other community development projects. Elevators are a large cost in the maintenance plan, and you'll see for DSS, the Public Safety Center, and general services needs over the next 6 years. And we went into major building renovations. This is the largest project type category that you'll see in your packet. A total of $36 million over the next 6 years. In fiscal year 26, we're at $8.4 million. You'll notice here in the middle that a vast majority of these projects are in the law enforcement detention center. We'll talk about a couple of those in a moment, but a lot of these deferred maintenance projects. A little bit about the category in general. It is reserved for projects that are over $100,000. So that's how we group them when they came to us from these facility assessments. That's how they made it into this bucket. So again, one of the biggest projects here in this category is this cell floor renovation project, and this has been noted as a deficiency by the state inspector and the local health department. So this is something that you've been used to happen. It is a large project. It will take multi-year. It will be a multi-year project, but it needs to be included in this year one to get the contract covered. The next category here is mechanical, electrical, and plumbing. I think Chantal mentioned that there are some significant HVAC issues. Total for 6 years is $15.6 million. You'll see in fiscal year 26, $2.26 million. Some of the larger projects we'll talk about here in just a second, but does fall under the sheriff's office category. This is the Public Safety Center, boiler and chiller. You may have seen these pictures also during winter work session. It's a big ticket item here at $1.05 million. And also the DSS HVAC system is scheduled for replacement.
How old is the DSS HVAC? I mean, is that?
Do you have DSS HVAC aid off the top of your head?
It's about 21, 22 years old, depending on when they did the startup. We occupied the building in 2004, so it was probably in place and operating sometime in 2003.
I mean, I realize different elements can break down and whatever else, but typically you don't have to do, in a big building like that. I mean, I kind of rule of thumb, James can comment on it, for me, it's got 30 years till you have to really do, you gotta do routine maintenance all the time. And you may have to replace some elements, but you're usually gonna last 30 years anyway before you have to do replacement. And I don't know what year this is in, and 30 years pushes you to 2034, 2033 out beyond some of that, is it?
Well, if we're talking about 2023 for DSS project, you know, we've got some big ones coming up here this year.
James, do you wanna comment on the 30-year lifespan for?
Yeah, Yeah, so it really depends on the components. Some items are 20-year lifespan, some are 25. On like your air handlers, those you may see up to 30 years as long as you don't have any corrosion issues that start to happen with the unit itself. And so that's something that just has to be monitored on a case-by-case basis.
I seen that picture that's included in the, probably on the previous page. I assume, is that one on the left, a part of the boiler?
That is part of the hot water tank that's over.
But yeah, which is the storage tank for hot water tank. I mean, obviously it's showing some, of course, is it leaking? I mean, there's all kind of questions. I mean, of how long all that stuff happens. I'm not an expert, but when you gotta make decisions, it just depends how you operate. If you operate that, we can get it, we got the money to fix it, then obviously you fix it. If you don't have much money, you make different decisions. And in terms of the criticality, if it's not leaking, it's one thing. If it's leaking, that's a big issue.
I think for us, we're really trying to also be proactive. We did meet the list of the facilities assessment, but besides that, if we keep kicking the can, we're gonna come to y'all with like $100 million. So we're trying to, in 1 year, we're trying to have a real plan for HVAC, a real plan for roofs.
I like all,
right?
I like it. I'm not disagreeing with that, but I'm probably just not, I'm probably just not comfortable with the amounts that we're talking about. That's probably it.
And what we can do, especially for each of these fiscal year 26 projects, is we'll get you a deep dive and a breakdown and maybe a per sheet for those projects to let you know exactly the need to make the case for each of those projects. So we can dig a little deeper. We've got the information compiled, several projects, and so especially for some of those big ones, we can get you the details of needs, maybe some work orders and things we've done, and the age of the facilities. We can get that a little bit deeper for you as well.
Got it. Thank you.
And in some cases, what was the design capacity? Because that's gonna determine your life. You can design a system to last you 30 years, and it's gonna cost you more at the time. So it's what was the useful life built into the design of the project?
If that's available. And kind of, they're certainly, 30-year-old building, there are more factors than that.
And what are the ramifications if it goes in a year that we haven't planned for too? I think that's a
Yeah,
factor
there's
as
lots
well.
of, if you gamble and it fails, what is your, what's it just shut down the building for 2 months? I mean, it's all those kind of things. There's lead times, ordering stuff now, there's all a gazillion factors, like switchgear.
Was this on the priority list?
The PSE,
Yeah.
it's on the priority list, and it's included in the capital plan. Absolutely.
Thank you.
Going into minor building renovations, these projects are those that might not make the $100,000 threshold. May see a lot of these in terms of parks projects, some smaller capital needs that come up that need to be done over the next few years. New construction still makes it into the capital improvement program. I know we're talking a lot about maintenance needs and deferred maintenance needs, but there will still be new construction needs, especially as we move forward. And again, this capital improvement program the goal is to look at this holistically for all of our capital needs, new construction and maintenance. The reason you see the ones that are here, especially in 26 and 27, these two projects are parks projects. One is Ballous Lake Phase 2. You'll see the project cost here, but that project is funded. The funding has been allocated by our 2023 PAYGO dollars and a grant from Cardiff. And so that project is, when we go and talk about the funding sources, you'll see that's been funded up to date.
How much was the grant?
$500,000.
And we had to provide 2.5 million.
We had to match it, that's a pretty big match, $2.5 million and $500 grand. That's an expensive grant.
That's why we got the grant.
I understand.
We paid for that grant.
I understand that.
So this project is in the works currently. And then the CG Hill, Phase 1 project is really related to our Cyworks property and to, for that land use conservation easement to transfer that off of that property so it can be sold.
I was just on the face when I read that, so obviously part of that's land purchase. Assuming that, but I hope it's certainly we're not planning on paying those kind of dollars for land. And then what we're hoping to do well, selling a piece of industrial property ain't gonna be anywhere near what those numbers add up to be. So I'm a little curious about that.
So we did get the appraisal back, and the value on that was around 4.1, 4.2 that we would have to acquire new parkland to replace. And so I think this assesses that amount, and then there is a requirement under the Landwater Conservation Fund conversion that you have to provide certain developments in that park within a 3-year period.
But they're pretty passive.
They are pretty passive, but you know, if it's trails, if it's, I think there's a rest area, and these are really kind of plug numbers at this point for future costs.
8.8 million.
Yeah, it's a large.
Land, you were saying it's 1.4.
The land is 4.1.
And obviously, I mean, as we work to get the whole Cyworks thing, I mean, we're only asking for 50,000 for FY 26, and once things firm up, the numbers for CG Hill may change. But we do have that, deed restriction that is problematic.
There's obviously a lot of unknowns in this plan. You know, the CIP is a living document. As we get more information, we're bringing on a consultant to assist us in that process. As we get more information, this could change in future years. We just have to work through it. So this is really kind of a plug number at this point. And you know, hopefully we have to acquire 4.1 million in value. Hopefully people will give us good deals. We don't need to spend 4.1 million, but we'll see. Doesn't usually happen.
Roofing and building, I think we saw a little bit about this photo in the winter work session. This is the animal shelter building. There's nothing included for 26 or 27, but as we move into 28 and beyond, there's some projects, also a large one for the public safety center roof replacement for 1.6 million. That'll happen in fiscal year 29.
And the one thing I'll point out to, on that is, you can see for the animal shelter, was built in 2006, a 15-year life, but our recommendation is to start that project in FY 2030. So I mean, we are working hard to try to extend things out as best we can. There are just some items that are not as easy to do that.
Another category here is sustainability, and this really stems from the December 5th, 2019 resolution highlighting Commissioner's goal to move toward a transition to 100% clean energy and renewable energy by 2050. I will point out there are 2 projects included in the CIP and 1 project for sustainability that's included as a Horizon project, which is for solar. And so we'll talk a little bit about that once we get to that project. But included here in the capital improvement plan is electrification of the fleet to continue that work that's already begun. We've have infrastructure projects in place, and we have 3 electric vehicles in the county currently. And so this funding for fiscal year 26 would add 5 electric vehicles to really max out our capacity for the infrastructure that's already been funded. It gives us a year to evaluate how those are being used, maybe return on that investment, and then to continue on in that infrastructure and vehicle purchases moving forward should the board decide to do that, but this gives the ability to do that. And then the lighting to LED countywide project is a way to transition all 18 facilities from traditional lighting into LED bulbs, and there is some Duke rebate opportunities if the board is interested in this project to do now, sooner rather than later. It does require the project to be bid out, especially for the larger facilities, the public safety center, the government center, the LEDC, DSS, and public health. But if this project is of interest, there's about $480,000 worth of savings for the materials to do it. So.
And operational costs in the future.
Right,
Absolutely. Right. I mean, per year, I probably, seems like I saw that for
Yeah, so we'll talk about it here. Right, and so this is, I think, minor in the room, but, just looking at this project in the Winona Library, it reduced the energy demand by 62%. Of course, that's not the only demand for the electricity cost that the building sees, but for the energy lighting usage to decrease by that is pretty significant. So we hope that there is some savings in our power bills by the project, as well as some other savings in our for carbon. Yeah.
For the LED costs, do you have any breakdown on how much of those are in building and how much of those are like parking lot lighting?
We've done some good work for where those are. I don't know about parking lot versus building. That is a factor for the calculation for this, like for the cost savings, I think. I don't know what to speak to that, but you know, right, which of these lightings is used for how long? That's certainly a factor of getting at an accurate cost savings. I'll see if we can find sort of how deep a dive we took to get to these. So this is countywide, all of these buildings. It's been an undertaking for the General Services Department thus far to get these numbers out.
Go ahead, Linda.
Yeah, it's my
You have
department.
you have something to add?
I just wanted to position myself so I could be more ready to answer a question if one comes up that I need to answer.
Well, do you know about the question on parking lot lighting or any of that for this particular item?
It's my understanding that this item was only for interior building lighting and not parking lots at this time.
Is it worth taking an accelerated look on the parking lot side, because that would be all that law with you, so.
Absolutely, we'll take that as a takeaway.
I think.
Thank you.
And then some offsets of annual costs from general services just for the purchase of the traditional bulbs that we do anyways. This is the technology category that we talked about a bit ago. I want to point out that the LEDC camera project was approved in 2023 PAYGO dollars for this 1.07, and that was to upgrade the camera system in the jail. Some work has been done on that project this past year, since that was brought to you last May. And we've identified that project cannot move forward until some additional infrastructure work is done at the jail. And so working with MIS, we've got a project cost on the infrastructure portion that is necessary before the cameras can be redone. So again, that 1.07 has been funded. We've allocated dollars for the 23 PAYGO for that. So the new money for that project is at 1.1. And if we can get you some specifics of that project if you're curious, but there's MIS is involved and can answer some questions about that in particular. And then one other technology project here in 2029. So there's a lot that's honestly what the plan is designed to be. It's designed to be project driven, a look at 6 years. So it's a lot of projects that come before you. But now we want to talk about our proposed funding sources. Again, this is for you all to provide your feedback on projects, on funding sources, approaches.
Mr. Chairman, I'm sorry to interrupt, but everyone needs a break.
Oh. All right. Sounds like a good idea.
Sounds like the perfect time to spend the money.
Try another, that's good, another 6 minutes. Try to
from the project driven look at the CIP into proposed funding sources, and just again starting high level, and we'll talk about the specifics. That just a reminder that any capital improvement program must have funding sources identified for all 6 years at the time of its approval. Only that year one will be included in the capital budget ordinance, but the funding plan needs to be identified.
It needs to be.
Right. The CIP funding recommendation currently includes a designated 1 cent per property tax rate. Also uses general obligation 2/3 bonds, limited obligation bonds, the prior year pay-go cash that was allocated from previous years, and grants, and that will be particularly of interest when we bring the airport projects onto the CIP as well.
If for any of that funding, is any of that already designated as something else, for example, the school system?
So they have, yeah, so tell me your question again.
The question again is, anything that you're recommending for the CIP funding capital, county capital funding sources, is any of that, has any of that already been promised to something else?
No. And so you will see a coordinated funding proposal that includes funding our existing plan for the schools, possible new money, and then this recommendation that you'll see for the county capital as well, separate, and you'll give it a half decision. So we'll let Lee Plunkett, Deputy CFO, go over the specifics of the funding plan. He may be able to answer some additional questions too.
All right. So what I wanted to do today was just to walk through just briefly what a potential funding scenario would look like for this type of CIP plan. And so what we've got here is just on the top here is just your summary of project uses. So the money going out of the plan being expended by year. But I want to focus in on the bottom chart here, the county capital funding sources. And so as Kimberly talked about, the one option, one recommendation for staff is to potentially designate 1 cent on the tax rate to fund this plan. And so this would go towards this first line here. You'll see a transfer from the general fund for 1 cent. And so each year is essentially what we're projecting 1 cent would be equivalent to. And so that would be cash infused into the plan. And then we would supplement it with other funding sources. So a couple of the non-debt related funding sources would be the amount appropriated from the 2023 PAYGO for $2 million, and I think an associated Part F grant for $500,000. That's in fiscal year 27. So that gets to those kind of one-time other funding sources as they come along to help fund projects. The bulk of the rest of the funding sources will be from potentially debt financing. And so what we've got first here, I just want to point out real quick, in fiscal 26, we've got GO 2/3 bonds. What we're recommending is potentially taking $2.1 million from additional premium that gets created from the sale of our upcoming bonds in 2025. So we take that money, apply it to any county projects, and put it towards the first year of this new CIP program. And then potentially looking at an initial startup funding from some type of limited obligation bonds or installment financing agreements. So those are really different from the GEO side. Just very simply, there's, I think David mentioned earlier, there's some collateral that's needed. It's not just based on taxing authority. So we'd have to have plans in place and be able to say this is the projects we're going with and to get approved by the LGC. The rate's a little higher, but there doesn't need to be, it doesn't need to be voted on by referendum. The board can choose to pursue that option.
But we're paying the interest on that every year going forward, so that's a new item for, right?
Yeah, this would be a new expenditure, and so I'll get to that in 1 second, because there's definitely a cost. It's not free by any means.
But back to the use question you just mentioned. What if you paid for the lighting upgrades? I mean, the lighting upgrades aren't a titled kind of building kind of thing.
Yeah, so to get to that, my assumption, just the way I try to work through these numbers up front and using that designated 1 cent, was I took a look at the useful life of the projects And so I said, what would it take to fund the projects with a useful life of 15 years and greater? And so essentially, what this does is it funds those projects with debt. And then this cash portion here, that's infused every year, that would fund the 15 and less useful life projects. And that would be ongoing, and the debt service, which we'll get to in a second. So we did look at that the cash would be able to fund, based off the way that identified by useful life, cash would fund all of the shorter useful life projects in this scenario. Again, that could change and we can move things around.
Yeah, let me ask a question on that 2.1 million, the premium part of the bond you're talking about. I thought when we did that sort of shore up issue, or not a shore, but an additional amount of money for the schools, that those were basically premiums that had not been used out of 2016 bond issue, as well as I thought it included the 2/3 bonds that had been sold up to that point. I assumed it included them until they got all that money, all the money that we were looking at, it included that. And we're not there yet. So is that 2.1 million not included? I thought all the premium opportunities were used to get the schools up to whatever it was, 78, 75 million, whatever it was. So you're telling me we didn't use, which ones did we not use, or did we use?
That's a good question. So the 2023 sale, we did assume that we're gonna utilize all premium and sweep it to the schools. The 2025 and 2027, we weren't sure which way we're gonna structure the sale of the bonds, so we left it as a project fund type of structure to where there would not necessarily be premium available. But given the needs that we have now, we decided, well, that could be an opportunity to pull in additional 2.1 million in premium. Same thing with the 2027 sale. We haven't assumed premium would be available for any project. It'd be a choice of the board to go forward with that or not.
So the schools is still getting the amount that you all would still get.
But
I thought we had committed all premiums and maxed out all we could do over the life of them getting their, whatever that total ended up.
Not for the 25 and 27 sale. We just assumed the project fund.
But they haven't received all that money yet. They haven't received the whole money from 23, because it's coming up in pieces.
From 2023, that's available to them.
Is that the last one that's included? Because they're getting 20 something in this one.
Yep, and this one, and then.
And that's the last one?
No, 2027 will be the last one.
So there is I thought there was another one coming.
You're correct.
They've not received all their money. So there were no bond premiums calculated for those two. For them.
Not yet. So that's an option, that's a board decision. And so let me, just to walk through real quick how this looks. So because of there's debt, there's gonna be associated debt service. And so we've included that in the uses within the funding plan. So what we did was an upfront sale here to jumpstart the CIP plan, and then in fiscal 29, piggyback off the already planned 2/3 bonds and max out our capacity there as well, to provide enough to cover the total 85.7 million. So we have 85.7 million in total uses. With the additional cost of interest, or principal and interest on our debt service is 24.5 estimated. So the total uses would actually be 110.1 million when you include the debt service for financing these projects. And then when you pull down to the uses table, you'll see that we've essentially made a balance at 110.1 million as well. So that obviously, if this is an ongoing thing, it's not gonna zero out probably at the end of fiscal year 31. You're gonna have ongoing projects that continue out into the future. But just to take a 6-year snapshot look at the potential way to fund the CIP, one potential option. We can spread the debt financings out over multiple years, especially if we're not doing general obligation bonds. Do some shorter term financings for the shorter useful life projects. There's a lot of different ways to look at it. This is just one option to give you guys a chance to take it in and see what your appetite would be for moving forward.
The number that jumps out as a red flag to me is you know, $34 million plus in LOBs and in cash, that if we sell those in this fiscal year, then the debt service from that is committed for the life of the project. This is not a decision that I thought, that I anticipated on our agenda for the next 2 months. So that's a pretty quick decision on a pretty significant additional financial obligation.
So it's, you know, depending on the timing, probably our FAs would speak more to this, but it wouldn't necessarily need to be decided in the next 2 months. So it would be a sale within fiscal 26, or any time within fiscal 26, you could sell the bonds. We'd have to look at the project timeline and when the project's going to get started, but if you take a look, using our current sale, you know, we started at the beginning of the year with the different actions that required. The last meeting was your first action to sell the bonds, and then this meeting is the second. And so we could do a spring sale like we have done the last 3 or 4 sales. We could wait till the end of the fiscal year to sell it. There's some different options that you can look at. So I don't think you necessarily have to make a decision within the next 2 months.
I mean, what I
Well,
would
the
say is,
decision- the decision-
in my manager's recommended budget, which you can approve, deny, and again, I'm not even anywhere close to pulling it all together. I'm essentially gonna be recommending a penny so that we can actually fund deferred maintenance needs or our capital needs. We have not identified recurring funding source for our needs. The majority of our money has gone to the schools. And I'm not saying not to give money to the schools, all I'm saying is we have the same needs the school has, and we have not had a recurring identified funding source. Our teams have been reliant on PAYGO if we've had money left over, and it's been for bells and whistles, not HVAC, salt floors, roofs, and those kinds of things. So I think that's the main thing that you will probably see in my manager's recommended budget is some sort of recommendation on how to finance or fund, I'm not gonna say finance, fund our capital needs.
And that's a separate recommendation, I see, from the $34 million.
It's the $6,382,905,
Right.
which would be, that would be a commitment for next year.
Yes.
And it doesn't have to be from, she used a penny to be, as to come up with the number, but I mean, it could be in the budget. The question is, will we balance our budget with that extra cost thrown in there without having to do tax increase issues? That's kind of what it gets into. And that, which is, and I'm with you, I mean, that has not been discussed or anticipated, but we have had one discussion prior to this about capital issues and deferred maintenance and problems.
I think that one's fair game, because that's one that you make on an annual basis, you know, honestly. You can say, okay, we're gonna plan, with, you know, thinking that this is going forward, but if we have you know, if the tariffs crash, you know, hammers our revenues, we don't have to make the same allocation in the next budget year. The item that I'm concerned about including in the budget that we are going to do this, whether it's this summer or whether it's next spring, is the 34 million.
And we can adjust, we can spread it out over multiple sales. I mean, that was just a way to say, hey, if we funded the first 3 years of 15-year and above useful life projects all at one time, that's the way to do it. The potential way to do it. And that was the total that came up to. So,
But anyway, that's
we can
why I
spread it
flagged
out.
it. Thank you.
I do have a question in regards to what Chair Martin asked previously about premiums. I kind of got lost in your response to him, and so if you don't mind reiterating your response to his question about the premium issue, and I probably may need to have Chair Martin ask that question again so that I can follow your chain of response, but.
Yeah, no problem. I will do my best. So, bonds are sold at a par amount. And so in your bond orders that you are gonna be up for consideration for approval, you've got a list of amounts by purpose, and that's would be equal to the par amount that we could sell on your behalf. So if we.
Lee, do you wanna go back to the slide that, the FA showed that actually had all of those designations? Cause I just think that would help with to see it.
But you can sell up to that amount, legally authorized to sell up to that amount. And so, for example, $2 million for general county purposes. Yep, there we go. So you've got the different purposes here that you can sell for, and so that you can sell up to that amount of par, so up to $2 million in par is what the bond market calls it. And so this is probably where I get the most turned around. If you want to come up, David, but the public finance market, they like a certain coupon structure, which is different than maybe the private sector. And so, for example, 5%, I'll use that as an example. If bond investors want to pay 5% for a tax-exempt bond, but as David showed, our true interest cost is only 3.75%. So the bond market is willing to pay over and above your par amount to buy our bonds. So they're gonna pay, say, $2.1 million to get, or you're gonna buy it for $2.1 million instead of $2 million. So you get $100,000 in premium because of the way tax-exempt municipal bonds are structured in the bond market. And so that gets us to that $2.1 million when you add it up over all the different purposes across all the issuance. That gets the additional $2.1 million that's available. So when Dr. Martin was talking about maxing out our possible capacity, it's saying you can legally sell up to this amount of bonds, and then because of the way that we're structured, the way the tax-exempt market works, you're gonna get additional premium for those bonds. Now, on the flip side, and what we have done, up to this point, is that we've promised the schools, let's say $27.335 million, $2.3 million for SciTech down the line. When it comes to sell the bonds, we'll go to the market and say, actually, we're gonna sell $26 million in actual par amount, knowing we're gonna get a premium for those bonds. So we still provide the schools with the $27.335 million that we promised them, say, when we put the referendum up for a vote. And it was just cheaper, because nothing's free, so if you do get this premium on your bonds, you're still paying the debt service related to that. So I know it's a lot. And we can
I guess
work through that.
my question is, and forgive my ignorance, I tried to absorb as much as I could. Are there additional funds through the premiums to give to capital projects?
Yeah, so right now, David has estimated $2.1 million in additional premium is available in the 2025 two-thirds sale that you all are looking to approve.
And in full disclosure, we just kind of found this out like last week. And so as we are working on our capital improvement plan, we identified that these are additional premiums that could help our own capital plan.
But I think that the question I asked was a little different. The question I asked was, we started talking to the schools about, what extra money can we give them, quite frankly, to help them bridge and postpone a bond referendum until 2028. So we can give you some money, and the money was based on, we had not exercised, correct me if I'm wrong, we had not exercised that premium from the 2016 bond issue, which was, what, $350 million, was the par value, he's calling it. So there was a substantial premium that had not been used off the 2016 bond issue. So that amount of money, and then we were looking at paying it to them over time, over their sales and other things. I thought we included premium values from the future two-thirds bond sales that occur every other year. So I thought all of those had all been lumped up together to get the number that we committed to the schools to help them. So apparently, we didn't. Apparently, we did not include the 25 and 27 2/3 bonds. I'm assuming we did the 23. I assume we did include the premium off the 2/3 bonds in 23, and then included all the premiums from the 2016 that had never been used, which was obviously not only the lion's share, it was most of it. So I just thought that we had counted on, since they had not received it all yet, I thought we had also counted on that additional 2.1 or whatever it is as well in this year and in 2 years.
That's good.
That's what I thought, but we didn't. So, like, if I put my school hat on from the past, it'd be, well, maybe you need to be giving that to us. Be probably what I'd be, if I was sitting out there in the school district, that's probably what I'd be thinking.
But I think the slides we showed you in either January or March, even the money we've been giving them, they have not been spending on average the amount that we're giving them. Anyways, and we can re-pull those slides, but on average, they haven't been spending all of the money, and we're still waiting on their capital improvement plan. And I think we've also showed that they've received the majority of the money. And I love the schools, and we're working collaboratively with the schools, but we can't neglect our sectors.
I understand it's just, these are buckets. Different buckets, different stuff, and what, I just said what I thought we committed. It's what I thought, and I thought it was all the premiums from the 3 2/3 bond sales plus the 2016. That's just what I thought.
Yep. And so the historically, except for this last sale, for the most part, we have done the project fund total. So we would reduce the par amount to get to the project fund that we want to provide. And so that's what when we projected out multiple years down the road, that's just the way that we've historically done it. We can change that and
Which,
move it however you'd like to.
by the way, by doing that in the past, our bonds got paid off quicker. I mean, the bonds were paid off before the 20 years were up, because that premium, because eventually, because you didn't have quite as much interest, right? I mean.
Well, it was not necessarily paid off quicker, but it was cheaper. Cheaper, yeah.
Okay, I got you. Yep. Money's money. It's cheaper, which is part of it.
So certainly it's a policy decision. I mean, we're gonna have our manager's recommendation, but it's, you are the policymakers, and you can decide how to utilize those funds.
I hear you, but you gotta have all the info.
And that decision may, first week of May?
Early May.
So if we decide to do it that way, or if we want to sell it, where we get that additional 2.1 million in premium, we need to know May 5th. I think it's a drop dead.
Yes.
If you decide to say, let's just issue up to that amount, not try to get that additional 2.1 million, we can do it that way as well.
And the other thing, to note, that, John just told me, if we don't do financing, which is fine, then it's about 2 cents that we would need versus 1.
To fund the entire recommended plan.
Yeah, but you make that decision a year at a time. I mean, this is singling out one item in a $500 million budget that we're translating in a sense. We don't translate anything else in a sense. I mean, it's more about, it has everything to do with tax increases, period.
I just wanna make sure that, for full transparency for the board, I wanna equate the dollar amount so that you understand what that means in terms of tax rates. And, I think what you will see from other counties and municipalities is they have real capital improvement plans. That's 5-6 years, we've not had that. In absence of a plan, if you have a plan, you have to have funding sources identified.
Yeah, but in the last 5 or 6 years, we spent a lot of cash. We spent a lot of pay-go money, which was left
Not
over
on
fund
maintenance.
balance. Well, it may not be on maintenance, but it was spent on capital stuff.
Agreed.
And the lines begin to blur between maintenance, capital, whatever, all that stuff begins to blur together because we we have fixed things in this county in the last 6 years that were paid for out of our budget somewhere, and I don't think it was, they weren't all coming out of the, some were 2/3 bonds, some were, you know, which were planned on, but some are, I'm sure, just parts of our budget, things that we paid for. We haven't, we've done, I'm sure, some kind of, we've done HVAC large expenses that were either not anticipated or not in the budget per se. I mean, go back and look, I mean, we did not do any maintenance, any capital, what you're calling capital improvement.
We've not
in the last 6
addressed the
years.
large issues. We've put Band-Aids on a lot of things.
I'm not.
Right, we've not had a
disagreeing with
real capital improvement plan.
Some of this is terminology.
Right, when I'm sitting in budget meetings with departments, they're not asking for bells and whistles. They're asking to repair sewers, so that it doesn't overflow. They're asking for roofs. They're asking for HVAC units. I mean, they're not asking for bells and whistles, and what we've invested a lot of dollars in is bells and whistles, and what we're really asking is just to maintain appropriately, proactively, the items that we have. We have a lot of facilities. We don't want to be in a situation where we have to expend a lot of funds we don't have because we've not addressed these core basic issues.
Well,
And we
I
can
think we need to be also, when we're using words, not everything we've done in PAYGO projects has been a bill that would ever qualify as a bill. What's sitting over here in the courthouse, that'd been a 20-year thing to finally happen, and that was not a bell and whistle. I mean, but it was money that was spent.
That was lobs, I believe.
It was, yeah, it was paid for with lobs, but it was capital that we did. This is lobs, what you're describing ultimately is a lob too.
Agreed.
So, I mean, it's the financing to do what we need to do. And the question is, the decisions that have been made, that we have made to do things, they are what they are. Now, can we not do some things? Well, it is what it is.
Just to be clear, I approve of a plan for the maintenance needs. I'm just less confident that we will have had the time by this year's budget to make a comprehensive review of which are the critical items that must be started or done now, and which ones are not deferred maintenance so much as they're deferred expenses.
I mean, I completely understand that. I mean, we've never, that I'm aware of, we've never had deep conversations with the board about our deferred maintenance needs, which is one of the reasons we're bringing this as part of just a budget workshop, because we want to make sure you all are very, clear about major components of our budget. And I will tell you, maintenance needs was one of the #1 issues identified when Denise and I went out and did employee listening sessions. This impacts employees' day-to-day lives. I mean, when they come into work, they want to be able to have the tools, resources that they need to do their job. Compensation, while everybody wants compensation, was not #1. Most of the stuff we heard was about the lack of kind of keeping up with our facilities, vehicles, like those types of things, and it was not what a lot of times people would think. It really was just about making sure we're maintaining what we have.
Question, if ARPA dollars was used for instance, the new project up the street here with the, at the, Health and Human Services campus, could that also have been used for maintenance projects versus new kind of projects that we were doing?
It depended on what it was, because there were some strict criteria with ARPA, so it really depends. I mean, again, with ARPA dollars, we did a combination of things. I mean, we were able to, the auditorium renovation, that's big, because that needed to be done anyways. We We've done a lot of things on the Health and Human Services campus, which provides services to residents, so I think that was,
So I would say that I would have wanted the auditorium renovated too, but when I look at what's going on over in, any of our buildings that's creating safety issues, and that becomes problematic, that renovating an auditorium that maybe not even really in use by the public, but we want them to use it, should take priority over, you know, what's happening over in our facilities, at, you know, wherever.
again, I think that what we are proposing is to make different kinds of decisions and different kinds of recommendations and in a more proactive way moving forward. I can't really speak to some of the decisions made in the past or recommendations made in the past. We're just hoping to try to do things a little bit differently.
Got it.
And Kimberly is gonna talk about just some of the Horizon projects, to kind of answer your question, did everything make the list? It didn't, but we also did not want you to not see some of the things that, were also brought to our attention.
Oh, sorry. Right, so these Horizon projects that we spoke about briefly are put into the same buckets that we've talked about for the CIP, the major building renovations and new construction and sustainability. A lot of these, the Streets and Parks projects, really felt like we did some policy discussion from the board. Some others that came to our attention, you know, some fire station work, some EMS, structural facility work. I think there's been work being done by Deputy County Manager Val Haney about a larger look at those facilities and our needs moving forward. So once we get some additional information back about those items, that may change. So we wanted them to be here for you to see them and know that there's work being done, but they weren't quite ready for the capital improvement program. And then the one sustainability project in the bottom. Are there any questions about these particular projects or any more information that you'd like about those?
I don't know enough whether to ask the question, but I'm probably, I think we finished phase 2 at Ballou Lake. You know, I think maybe take a look at whether phase 3 is not one that gets postponed further. And that's the one that jumps out in that list. And
Which is why, I mean, at this point, none of these are recommended at this point anyways. I mean, it's just more of, these are things you all have discussed previously. Some newer items, certainly needs a little bit more fleshing out, but we also just wanted to make sure it stayed on your radar. You know, like EMS stations, I mean, we're gonna be doing a study of what that looks like. So again, nothing identified, but just kind of putting something as a placeholder, because that will probably come back at some point. If you wanna do solar energy as part of the sustainability plan, I mean, this requires more policy decisions, you know, on just what you all would like to do.
Just to be clear, the funding proposal that you've seen does not.
oh, yeah,
projects are
I
not
know
included.
that. I mean, this adds another 30% to it. Yeah, I got it.
And the other thing we do wanna make sure you, recognize is that in the past for the 2/3 bonds, parks and county facilities have been separate. We want to combine it as just, again, what are the county's capital needs, which includes parks. And so we essentially have been having $1 million for county facilities and $1 million for parks on an annualized basis. And we would like to just look at it as it's $2 million, and then for whatever the needs are, regardless if it's parks or county facilities. And parks, of course, is included in the plan in general.
Just a quick overview of the solar project here, if you're curious, and we can give a full breakdown as we move forward into the CIP. But fiscal year 26 for this solar includes animal shelter, the Ramona Branch Library, 27 automotive services building, Crawford Extension, Bull Hall Library, 28 government center parking deck, and that corresponds with some big work that's needed on our roof and skylights that we talked about in the winter work session. and at the Central Library at 29, and Highland Avenue Center in fiscal year 30. So a lot of good work's been done by the sustainability committee to really get a 6-year plan for that if the board is interested in that project.
Yeah, in doing those, that calculated and working, it's nice to see what you believe would be sort of the payback, sort of, because the payback of all that is what you're basically reducing your electric bill by. And I mean, it's, obviously we can't project electric bills 6 years from now, but we can certainly look at what we might save in today's dollars with kilowatt hours.
And we do have a lot of good work that we've done on that project in particular, and so we'll be sure to get you some specifics.
That makes it a
for
lot
that
easier
solar.
to say, this has a return, this is a true ROI return investment deal to look at.
Agreed. We'll get you the specifics for that project in particular. So this has been a lot in the new capital improvement program for you today. A lot for you to think about. Again, the point of this is to get your feedback on the plan, the project, the level, the funding. More work to be done with the schools to give you the full CIP picture, and so we'll go back and finalize the funding plan based on your feedback to make some adjustments, and then with the goal again to bring you a balanced CIP for your approval, for the 6-year approval, and for that year 1 fiscal year 26 budget ordinance adoption with the general fund budget. So you'll see us again, but those are next steps, and please reach out with any thoughts, comments, concerns as we continue work.
So Kyle's going to wrap us up, just to give you high level some of the other budget drivers to make you aware of before you receive your recommended budget.
You've heard me say before, people, schools, and debt, that's what our budget is. I mean, it's 75–80% of our budget is our people, and then the schools, including the school system, Ampersand Tech, and debt. You heard a little bit from Shannon earlier about the people impacts that we're going to have, including the elders retirement increase, the health insurance that we're still working on. We're going to follow up with you on what the cost is from 1 to 6% versus 1 to 5%. We'll get that for you here shortly. School funding, the recommendation will be based on a funding formula as the plan at this point. But that will still be an increase year over year. Debt service is increasing based on a new sale. The other, there's an implication on the revenue neutral tax rate as well when we talk about debt service. So, on the last, I'm not sure if we did it in the March workshop. I know we did it in the work session. We showed you a preliminary revenue neutral calculation. And so this is based off of the April 1st estimate that came out last week. And so again, as the calculation works, you look at what your value was, what the tax base value was in 25 versus what it is in 26. The amount of revenue that was generated based on our current tax rate of 67.78 cents. And so it drops it down to 48.5 based on, just to get to the exact same revenue. Then there's a growth factor of 2.5%. And so it gets you to a preliminary, again, revenue neutral rate of 49.72 cents. So that's where we're at here. The impact that I would want to mention with the debt leveling portion. So as you'll recall from our FA's conversation before, when looking at the debt leveling portion of our tax rate, it's been 11.5 cents for the past several years. And based on their modeling, they're suggesting decreases down to 9.35 cents. And so that is to ensure that there is enough funds in future years to make up for that debt leveling portion. If you look at it from a revenue neutral calculation, the debt leveling rate would be 8.44 cents, which is a loss of almost $6 million for county operations. What I would, the way I kind of look at that is, our operating tax rate has been 56.28 because of the 67.78 minus the 11.5. And so with this revenue neutral rate, if we were to go to 49.72, the operating tax rate is really 40.37 instead of 41.28. So again, it's a loss of about $6 million by not going fully revenue neutral. So I'm not saying we should by any stretch saying that. I'm just, again, showing there is an impact on the overall tax rate based on that. And so that is a revenue consideration. The other revenue consideration I mentioned here is, as you know, the last four budgets, we've included basically a revenue loss transfer from the Pandemic Response Fund of $6 million, which is basically kept our tax rate lower on average by 1.37 cents. So we've used these revenue loss dollars to really suppress our tax rate by 1.37 cents over the last 4 years. And so again, it's another revenue consideration for next year. And then just lastly, on revenue, if you look at the one-time revenue that we included in the adopted budget, we have our $19.8 million, which is our target for reversions. That equates to 4.32 cents. We had appropriated this LEOSA fund balance that we had said we didn't need to carry forward anymore, equivalent to 0.69 cents. We had some other funds that we transferred from different CPOs. And so the overall picture is, an impact of 6.81 cents on the tax rate in the FY25 budget, but we did not include. So really, the tax rate, if you would have been 74 something, so it would have been, that was a one-time money that we appropriated in FY25 that we have to make up in FY26. So just wanted to
And the only reason we're showing you that is, again, it's the reality and challenge that we are facing. We have balanced our budget with over $31 million of one-time revenue for recurring expenses. These are not one-time expenses. And so, we're trying to do everything we can on our end to figure out ways to cut costs and reduce budgets and those types of things. But we want to be very transparent with you so that you know kind of the situation we're facing. We certainly will have some various recommendations for you, but I don't want you to be blindsided when you receive the recommended budget, as we are really trying to just overcome some of these challenges.
But your projected fund balance is only, what would you say, 7.7 million? Projected amount of fund balance, actually appropriated fund balance is going to go down from the 18 something to about 7.7.
Right. Yeah.
So this was 19.7 on the west, but so what we're really talking about is about 24, 25 million, not 31 million.
Right, and we've also, we have taken steps to right-size the budget this year, and so that will account for some of this. But then again, the drivers that we have on the personal services side, the increase in debt, the increase in, it's almost
Health insurance and all of those. You are correct. We are trying to decrease the appropriated fund balance amount, but we wanted you to see what was actually adopted in the budget. The FY25, those are the numbers that were adopted. And so, for this fiscal year, we're trying to do some things to try to change the trajectory. And certainly as we go into FY26, we have some more work to do.
A portion of this was really the revenue loss transfer. And so really, and again, you're right, that's our target that we don't want to spend. So exactly right, that's good. But those are the revenue considerations that we're grappling with right now, and like Chantel said, she's going to present this recommended budget to you on May 8th. And we'll do a detailed presentation on the 15th, have the public hearing on the 19th, some workshops the weeks of the 22nd and 29th, possible, or hopeful adoption of June 5th. My daughter's birthday, she'll be 24, so that's good. So that's a good day. And so yeah, those are the dates coming up. And that's all we have here today. We've got some follow-up items. We've listed them up here. I think I've got a couple more written down, and we will get those. We'll get those questions answered as soon as possible.
There's a lot of stuff.
That's good.
To kind of wrap your head around.
Yes, ma'am.
Oh, no, I was just saying.
My feeling exactly.
Thank you for all the preparation work. I mean, it's been a lot of work going on, and some good thinking
I will say,
on the capital issues. I share some of Dan's concerns, but where we are, it's good though. I mean,
I will say, the departments have done an excellent job this year of, getting the requests in and then working with us on our mid-year estimates and trying to reduce those. So we can't say enough positive things about departments. My staff's done great work in concert with finance and Terry and me. They've been amazing. John has been really a godsend for us, and everybody, we're thankful for everybody's cooperation and help this year.
it's good. Well, thank you all for that. Anything else for the order here?
None of this happened on my watch.
Needing a definition of bells and whistles.
Oh, I can give you a list.
Mr. Wilson, and July the 2nd is on your
Well, thank you. We appreciate your time, attention, your engagement. Again, just know, we know we can't fix everything in 1 year, nor are we suggesting to do that. Our biggest goal is just to structurally balance the budget, and then that will position us to be much better moving forward. So if you have any questions, comments, concerns, you know where to find me. I do appreciate your time, and certainly appreciate all the efforts of the staff, because there's been a lot of stuff happening behind the scenes. So thank you.
All right, thank you. So we're adjourned.